Get a rare opportunity to talk about some football in, so let's squeeze it in. And a rare opportunity to say the following. Newcastle, top of the league. Ian, expectations for this season?
I think we finished 5th, which would be frustrating because obviously we'd like to finish 4th and get the Champions League spot. But there's some really strong teams. The emergence of the stronger Chelsea in the latter part of last season, I think, makes it much more difficult for us to get to 4th. But you know, we started okay with a win despite being 10 men for 60 minutes. And yeah, I think without European competition this season, we're playing a lot fewer games. Hopefully we'll have a lot fewer injuries than last year's total train wreck disaster. And I think we've got the nucleus of a really great side.
Did you get your season ticket back?
At least 4 other good ones.
Did you get your season ticket back?
No, but you know, my big news is that I've emigrated to France, so it's a bit tricky to get back every other week.
There we go. Ian, thank you, sir. I'm not sure what to make of the big move, but we can talk about that another day. Ian Shepherdson,
another time,
of Pantheon Macroeconomics. Up next on the programme, your lineup looks like this. Bob Dole of Crossmark, Tobin Marcus of Wolf Research, Mandeep Singh of Bloomberg Intelligence, Ryan McKeveny of Zalman, and Stuart Kaiser of Citi. All of that and more still to come from New York. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Well, I think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investment that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issue, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We're still on the path for a soft landing.
A policy rate closer to 3.5% to 4% is probably where we should be trending.
When we think about rate cuts, we're thinking 1 a quarter.
for 8 quarters, not won a meeting.
The Fed, in my opinion, is going to go very slowly.
Bond markets actually are running well ahead of even what the Fed may say coming up to Jackson Hole.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
How much scope is there for disappointment today? This big focus on Chairman Powell's speech in Jackson Hole, Wyoming. This came from Mohamed Al-Erin yesterday on this program. It is problematic in my mind that the market is pricing in so many rate cuts right now. The market is overdoing it. We'll have that conversation this hour. Equity futures right now on the S&P 500 firmer up by 0.6%. On the NASDAQ 100 punchy up by 0.9. On a Russell, the small caps up by 0.6. The only event on the calendar going into the weekend is the most important event, arguably, of the week so far. It is this one right here, 10 a.m. Eastern Time. Chairman Powell from Jackson Hole, Wyoming. How offside are we? How dovish can he be relative to market pricing? This is something that Ian Ligonabimo had to say. It's striking that the outlook has quickly dimmed to the point of once again pricing in more than 100 basis points of cuts by year end in the absence of a tangible breakdown in the labour market. Stuart Kaiser alongside me for the next hour or so. Stu, what do you make of that? How offside do you think things are going into this?
Maybe a touch, but look, again, the market is pricing a range of outcomes. It's not pricing sort of a point estimate, right? So I think the market is probably pricing 50 to 75 basis points of cuts into year end, with the chance that the labor market really comes under pressure and they need to cut more aggressively. So, I mean, I still think the market, frankly, is a little bit in the soft landing camp, but they're seeing payrolls where they are. They're seeing the risk reward deteriorate. So they have to add some risk into what's priced into the forward curve for rate cuts. So
I'm worried about a repeat of August 2nd on September 6th.
Yeah, so in that case, then I can't go into that. I can't go into September with 50 basis points of cuts priced if I'm worried about that. So I think, and this has happened in the past, right? This happened in 2023 as well, when we had a lot of cuts priced into the back half of the year because folks were expecting a recession. Recession didn't materialize, and those cuts got priced out. Did they get priced out, or just did the odds of recession come down enough where your sort of emergency cut pricing, resolved itself?
Remember the story at the start of 2024, we were talking about 6 or 7 rate cuts, and then that quickly disappeared after Q1 inflation data. Here we are sitting here at the end of August with 2-year yields still close to about 4%, 3.99. Your 10-year at the moment down about a basis point. The 10-year maturity trading at about 3.84. In foreign exchange, the euro a little stronger, dollar weaker again. Euro dollar 111.21. Coming up this hour, we'll catch up with Bob Dole of Crossmark ahead of Chairman Powell's remarks. Tobin Marcus of Wolfe Research as Harris accepts the Democratic presidential nomination. And Ryan McKeveny of Zalman Associates on the state of the U.S. housing market. We begin with our top story. Stocks rising as traders await Fed Chair Jay Powell's remarks at 10 a.m. Eastern Time. Bob Dole of Crossmark writing the following: the global economic expansion remains intact and will benefit from rate cutting expectations. Equity valuation remains at risk, especially if growth continues to decelerate and the Fed does not show urgency. Bob joins us now for more. Bob, I want to talk about a gap, a spread, if you will, the difference between Fed funds and the 2-year. You've noted that's the widest going all the way back to 2008. And when people say 2008, Bob, they get worried, concerned. How worried and concerned should they be?
Well, the jury is out. The economy is slowing. I don't think people can dispute that anymore. But we don't know, is it going to be a soft landing or a harder landing? And look, that's, in my view, out of the Fed's control. The Fed, what he does in the next few meetings will impact the economy later. So it's already cooked and we just don't know. So if you want to be fearful, pretend there's going to be a hard landing. Not out of the question. The consumer's slowing. You're seeing it all over the place, but we just don't know how slow they're going to get. That's the problem.
Well, play best guess with me now. Let's take that spread. You've got Fed funds up here and the 2-year down here. How do you expect that to close? Is it the 2-year yield coming up to Fed funds coming down, the two meeting each other? What's that going to look like?
Look, the Fed's going to lower rates. The chairman will make that clear today. But as you and Stuart talked about earlier, we just don't know the pace of that decline. You recollected appropriately, January 1st, we're going to get 6 cuts this year. Oh no, it's going to be 7. Well, here we are, and we haven't seen one yet. And so I think it'll be slow but deliberate, and the language will be, we'll watch very carefully. Look, inflation, remember, is still 2.8. It's not 2. So they have to have their one eye on that corner of the world, too, as they on the other hand, begin to fight this emerging economic slowdown.
Bob, we've rallied into this story. We've noted that the equal weight S&P 500 has printed a couple of all-time highs so far this week. We've seen the leadership come from the small caps at times once again. With that in mind, are we more at risk of this data coming in weaker all over again on September 6th?
I absolutely agree. That's the question mark, and that is the risk, that things slow down faster than the market is expecting. And there's a little bit of, well, whatever ails us, the Fed will have the cutting power to fight that. Well, you know, what the Fed does today doesn't affect the economy for some time. A little psychology maybe, but that's about it. So it is, how fast does this thing slow?
But Bob, along those lines, I mean, how sensitive do you think the Fed is to financial conditions here? How reactive would they be if we got, you know, a sharp pullback in equities on some weak labor market data, in your view?
I think you bring up a good point, and that is things that might be out of our control. Look, we had that a month ago. It turned out to be, you know, the Japanese yen carry trade, and you know, as the market was falling those 3 days, we just had some clues. It was no, it's a fear about the economy falling apart that's causing this decline. Well, maybe that's what started it, but we know what aggravated it. So to your point, the financial system doesn't necessarily operate smoothly every day, and we could get a bump there as well. Not predicting that, but there is always discontinuity in the system.
And you mentioned high valuation. I mean, would you have the view that the market kind of needs some rate cuts given the level of valuation here, or do you think, you know, we can kind of skirt through things if growth stays okay?
I love the way you put it. Valuation is demanding a good environment, maybe a perfect environment. And therefore, the Fed better do exactly what they need to do, and earnings better come along, and we better not have any more consumer weakness. A lot of good news in this market with the PE into the 20s. So, yes, we do need to justify these valuations, reasonably good economic news and or Fed assistance.
What would you advocate for going deeper into the second half then, Bob? I'm just sitting here guessing that you're not telling everyone to sit in cash and take 5% and wait it out. What are you telling them to do?
Exactly. On the other hand, we've got this momentum-driven bull market, and you know, fighting that kind of market is a fool's game. So you got to be invested. Just be careful what you own. You've heard me say it before. Earnings predictability, earnings persistence, and cash flow. So should we get into sort of a bumpy environment, those kinds of stocks will sell off less, but they'll do just fine on the upside.
And Bob, a lot of those stocks you described, I think, are what people have kind of owned, you know, for a period of time here. Is that a steady as she goes, or would you worry about positioning, you know, being so long of those kind of stocks if we did come under some pressure? This is a debate we feel like we're having on tech all the time. Are they safe or not, basically?
Yeah. So I would broaden the list. Valuations got to come into the question relative to the earnings persistence, et cetera, list that I put together there. I wouldn't just own high PE stocks. They have some vulnerability should things not go all that well. And back to what Jonathan said a few minutes ago, the market is broadening. And to those of us who are a little cautious, that's a good sign that we're getting some broadening. I guess it couldn't get much narrower.
Yeah, I mean, I think that's the question we get on the broadening theme is, am I willing to broaden out into a weakening economy? And I feel like that's like a big trade-off that people are struggling with. Do you have a view there?
Yes, I do, and that is be careful how much broadening you do. We all know that down cap, small in particular, tends not to do well in economic slowdown environment. They do best when we come out of a recession. And so I think don't be zero in those areas, as many people are, but don't overdo it. I mean, we've lost 2/3 of the small cap rally we saw in July relative to big cap. That's a lot of deterioration, despite the broadening that we're speaking about here together.
Another way of asking the same question, do I want to own financials going into the back end of this year, Bob? Yes or no?
Yes, absolutely. I think look, a lot of lending took place outside the banking system. That's why bank balance sheets are on average, better shape today than they are typically at this point in the economic cycle, and they're pretty cheap. So, yes, I would own financials.
Big bounce off the low from earlier this month. Bob Dole, across Mark. Bob Dole, thank you. A couple of dates we need to think about. Mentioned September 6th a million times. August 28th, NVIDIA. Given where leadership is right now, would you say September 6th is more important than the earnings we get from NVIDIA next week?
Well, one comes first. So, look, to me, the payrolls number is more important for the overall market. But I mean, look, NVIDIA is A, a huge stock, B, a big part of performance, and C, you sort of have this feedback loop within large cap tech about stocks buying from one another, CapEx from Google, Microsoft going through to NVIDIA. So the risk you run there is if you were to get a disappointing result from NVIDIA, does that kind of spill out more broadly to that entire cohort?
That stock not immune to some wild moves as well. NVIDIA right now at the pre-market up by 1.4%. The Nasdaq up by something like 0.8%. The S&P at the moment on the S&P 500 futures up by 0.6. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers.
Hi, John. Freight trains in Canada could be running again within days after the government stepped in to resolve a labor dispute that halted work. The intervention is aimed at averting an economic crisis across Canada and the U.S., with commodities like coal, wheat, and lumber all depending on the railways. Both Canadian Pacific and Canadian National, the railways in the middle of the dispute, issued statements saying they were preparing to restart operations. And Alibaba shareholders have approved a plan to upgrade its Hong Kong listing to primary status next week. It's a move that's expected to attract billions of dollars in investment from mainland China. Shares of Alibaba have significantly underperformed those of rival Tencent this year, as China's weak retail sales have hurt Alibaba's key commerce business. Meanwhile, shares of Ross stores are rising in the pre-market, up more than 5%. The discount chain beating Wall Street expectations and raising its 2024 profit outlook as it saw more demand for its discounted apparel, while freight costs also eased. The company's results align with other retailers like Walmart and Target, which have shown consumers across the board are searching for bargains. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Let's pick up on that story. Ross Stores up by something like 5% in the pre-market. Home Depot, Target, Ross Stores, okay. Lowe's, or rather Lowe's Home Depot, and what's happening with Williams of Sonoma, terrible. The likes of Target, Walmart, and the likes of Ross Stores, okay. Compare and contrast what's happening there. Is that sort of like home improvement versus consumer staples? What is that?
It does sound like that a little bit. I think some of the comments from Home Depot and Lowe's were that people were sort of, pushing out the decisions to make these bigger expenditures, whereas maybe they're a little more comfortable with the one-off, smaller purchase that's, good for your mood for the rest of the day type situation.
Is Ross Stores good for your mood?
I don't know if I've ever been to Ross Stores, but so I'm going to say probably yes. They probably have a vibe I'd appreciate.
Good for your mood if you own that stock this morning. Stock's up by a little more than 5%. Up next on the program, Harris, making it official.
I promise to be a president for all Americans. You can always trust me to put country above party and self.
That conversation up next.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Stocks on the S&P up 0.5%, a little bit of a lift here in equity markets. In the bond market, yields lower by a single basis point, the 10-year 3.84. Under surveillance this morning, Harris making it official.
I promise to be a president for all Americans. You can always trust me to put country above party and self, to hold sacred America's fundamental principles, from the rule of law to free and fair elections to the peaceful transfer of power.
So here's the latest. Kamala Harris's acceptance speech closing out the last night of the DNC. The vice president pitching herself as the candidate focused on the economy and lowering costs for Americans. Tobin Marcus of Wolf Research noting the following. We read the Harris campaign's approach to policy is driven by strategic ambiguity, in which she will try to broadly signal her values and the issues she will prioritize, aim to connect with swing voters using populist economic rhetoric, but avoid getting pinned down on the details of policies that would be unpopular or problematic to implement. Tobin joins us now alongside Bloomberg's Anne-Marie in Chicago. AMH, over to you.
Good morning, Jonathan. Well, we heard from Harris last night, very heavy on vibes, light on details. This idea, Tobin, thank you for joining us, of strategic ambiguity. At what point does she need to come out and get more into the details of what she stands for in her policies?
So she's going to have to subject herself to some interviewing at some point. Like, she will have to answer questions sooner or later about exactly what she's thinking here. But, you know, frankly, it's a question for voters. And I don't know that policy details are the thing that people are hungering for. The contrast between the candidates is very stark. And as long as people feel like they have a sense of which, you know, what the directional choice is, it may be the case that she can continue kind of floating above some of these debates about.
Will the former president push her to be more detailed-oriented on policies? Because he certainly tried to do that last night as well as very early this morning.
Yeah. I mean, he's certainly going to try and pin her down. He also is someone who has a mixed relationship with how much detail one needs to provide on policy, kind of how much you need to spell out your plans. You know, but again, like, they're going to meet in the debates before too long. That'll be a really important moment for the campaigns, but I don't think that the basis on which most voters are going to be assessing that is kind of how, you know, many 14-point white papers did you explain? Like, they're going to be looking for them to go toe-to-toe, sort of show toughness, readiness for leadership. And he's going to be attacking her on her record at least as much as her plans.
You also talk about the fact that she disavowed a lot of policies positions she took running in the primary in 2019. I'm thinking about fracking, Medicare, defunding the police.
Right.
Who does she lose by those flip-flops? Is it the progressives or is it potentially the centrists that are questioning, why do you keep changing your mind?
Well, if she were going to lose a lot of support from the progressive wing of the party from abandoning those progressive positions, I think this is the week we would have seen it. And the fact that we had kind of all the big names on the left wing of the Democratic Party out there, you know, cheering, lending their support to hers, shows that they're totally prepared to take her triangulation in stride and live to fight another day. So the question on that, I think, is going to be, you know, when you're talking to swing voters, can you give some plausible account of what happened? Like, do people find it credible for you to say, I just no longer support a fracking ban, oil and gas production are at all-time highs, and not really give much of an account of what happened?
What states could potentially that hurt her in? I'm thinking of Pennsylvania, but where else?
Yeah, I mean, I think fracking in Pennsylvania and, you know, to some extent, potentially sort of Michigan, the rest of the upper Midwest that rely on sort of cheap industrial inputs. Those are the places that you'd probably worry about it the most. By the same token, the shifts on the border are a thing that you'd expect to be problematic across the Sun Belt, you know, those border states of Arizona and Nevada.
Trump was at the border yesterday. He's going to be in Maricopa County today. So is RFK Jr. And there's all this speculation that RFK is going to come out and endorse him. Potentially we'll see that today in Arizona, a swing state, in Maricopa County, a swing district. Right. Could an RFK Jr. endorsement of Trump push Maricopa County, say, to the red column?
Conceivably, you know, but his support has been trending down. So I think it's important to say, I think it clearly helps Trump to have RFK drop out and endorse him. The question is how much it helps him. His support has been trending down, and I think there's a big question about how much of that support can he deliver. Are the 4 or 5% of people who are still supporting RFK, are those RFK voters and loyalists, or are they just people who don't like the choices that they've been offered and are taking him as sort of a general purpose protest vote release valve? In that latter case, he may not really be able to turn on a dime and say, my voters, here's where you should go now.
Trump is also going to be in Las Vegas before he goes to Glendale, Arizona. He's going to be talking about this idea of tax on tips, which now everyone seems to be for. He's leaning into the economy and immigration, the top two issues. How does she combat him on these top two issues where he polls better?
Yeah, so I mean, on the economy, we've seen her really dramatically narrow the gap in terms of ratings on trust on the economy. Harris versus Trump looks a lot closer than Biden versus Trump, even if she's still at somewhat of a deficit. I don't know that she needs to get ahead of him. She just needs it not to be kind of a gaping wound the way that it was with Biden. And frankly, this sort of broad message of charting a new way forward rather than going back is an effort to separate herself from Biden just as much as from Trump.
But going back, I mean, she's part of the Biden-Harris ticket, that administration. I want to get this perspective from you. Why do voters not consider her as part of the past 3.5 years?
Yeah, well, so I mean, I don't think it's a settled question yet whether or not they're going to look at her that way. Certainly the Trump campaign is going to try its darndest to characterize her as part of the past. And fascinatingly, we saw a really mixed relationship with the record of the Biden-Harris administration over the course of the past week. When it came to things that they want to present as accomplishments of the administration or signs of Harris's readiness, then they're characterizing her as she was part of this effort over the course of the past 3 years. When it comes to things like the economy, the bitterness that voters have over inflation, that was the other guy's problem.
It seemed like she cherry-picked what she liked from Biden yesterday in the speech and avoided things that she didn't like. Were you shocked by anything that was omitted?
No, not particularly. I think that they've made basically smart decisions about where to aggressively tack to the center, where to kind of continue proudly defending the positions of the Biden-Harris administration, and then where to try and strike a kind of a populist middle ground as they have in the economy. The question, again, is whether or not voters are going to buy those pivots and that triangulation and sort of accept those as authentic representations of what she would do going forward, rather than some of these positions that she took longer ago.
Last night was very different in terms of the feeling on the convention floor than if it was Joe Biden there. Just a month, it's pretty drastic how quickly this has changed. What does it mean for down ballot races? Yeah,
I mean, it's the polling that we've been seeing in Democratic Senate races, for example, has been very, very, very strong, even more so than Harris's. They made a very intentional effort to trot out a bunch of Democratic Senate candidates throughout the week. But it seems pretty clear that sort of unifying the party, generating that enthusiasm, the huge influx of money that she's gotten, I think also helps up and down the ballot because the resources, frankly, are more important at the House and Senate level than they are at the presidential level. So getting these sort of massive boom of fundraising that may eventually also sort of convert into door knocking, organizing, I think that really helps candidates up and down the ballot.
Some of the policy proposals we've heard, though, on the economy, she needs a Democratic House and Senate to get through. When you're talking to clients now, what are you suggesting to them on how to look at the composition of Congress?
Yeah, so I mean, I think the House will very likely go the same direction as the presidency. Certainly if she wins, I think the strong expectation should be that Democrats also carry the House. The big question is the Senate in a Harris governance scenario. And I think that despite the polling shifts that we've seen, Republicans are quite strongly favored to take back the Senate. They're definitely flipping West Virginia. I think they're pretty substantially favored in Montana and Ohio. And so in all likelihood, even if Harris wins, she's going to be dealing with divided government.
Does she have strong Republican relationships in the Senate, given the time she spent there?
I mean, I think she has a few at the committee level, folks that she had a strong working relationship with. But, frankly, the things that she was most distinguished for in Congress were fairly adversarial things. I don't think she got a lot of, Republican plaudits for some of the grillings that she did of witnesses and so forth. That were sort of her, viral moments as a senator. I think that she will be leaning in part on other Democratic senators, on folks that she brings into the White House to try and build that connective tissue for negotiations.
Tobin, thank you so much for joining us. Jonathan, that was Tobin Marcus of Wolf Research, joining us really just on 2 hours of sleep, given how late last night went. I love what he says, strategic ambiguity when it comes to policy. And Jonathan, you can expect a lot more of that from the Harris campaign.
Get some sleep. Get some sleep. Anne-Marie, thank you, from the DNC in Chicago. If you missed that quote from Tobin, I want to share it with you all again. This is what it sounds like. We read the Harris campaign's approach to policy is driven by strategic ambiguity, in which she will try to broadly signal her values and the issues she will prioritize, aim to connect with swing voters using populist economic rhetoric, but, and here's the but avoid getting pinned down on the details of policies that would be unpopular or problematic to implement. Here's a takeaway here, Stu. The benefit of this candidate not going through a primary again and being tied down to progressive positions that would be unpopular on the national stage, the benefit of that is absolutely massive. I don't think you can overstate it. If she had to repeat some of the things that she was saying back in 2019, can you imagine where these polls would be?
Yeah, no, I agree. Strategic ambiguity is probably the way to go. I think most politicians wish they could be strategically, and have that going on. For investors, it's tricky though. And
much trickier.
You wonder, can I just assume the Biden policy is transformed forward, or do I actually need to adjust to a new reality where the policy base might differ? And to your point earlier, it does make trading the election a little bit trickier than it otherwise would have been.
Super hard. How are they going to govern? We don't really know because they're not really telling us. Coming up on this program, NVIDIA preparing to report earnings next week. Mandeep Singh of Bloomberg Intelligence will join us ahead of that key event risk on next week's calendar. Equity futures on the S&P 500 positive here by 0.5%. In the bond market, your yield, a 10-year 3.84, a 2-year in and around 4%. That address from Chairman Powell just a few hours away.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal?
Are markets too optimistic?
How do you worry about the things that are outside your control?
How does the current fighting completely stop?
I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Two hours away from the opening bell. Equities, your scores look like this, up by 0.5% on the S&P 500, up by 0.8 on the Nasdaq 100. The next big stop for this market, of course, is Chairman Powell at 10 a.m. Eastern Time. After that, we've got some earnings from NVIDIA coming up next week. We'll talk about that in just a moment. I wish NVIDIA would report earlier, given their importance to this market, but that's another conversation for another day. Or another conversation for Mandeep Singh of Bloomberg Intelligence, who will join us and try and answer that question for us. In the bond market, your 2-year, 10-year, 30-year shaping up as follows. Your 2-year, 3.9955, a 10-year at 3.8426, 4.1158 on 30s. Yields higher across the curve in yesterday's session, following better than expected jobless claims. We've had 3 weeks of pretty subdued jobless claim data, just calming the environment going into this address from Chairman Powell. Let's turn the page and switch up the board and get to foreign exchange. We'll sit on the euro, unchanged at 111.12. Let's talk about the yen, 146. This came from the BOJ governor a little bit earlier on into the session. He said, we are unable, or rather, if we are able, to confirm a rising certainty that the economy and prices will stay in line with forecasts. There's no change to our stance, that we'll continue to adjust the degree of easing. That sounded like a man, Stu. I don't know about you. It just sounded like a guy who was willing to hike interest rates again over at the BOJ and kind of shrugging off any contribution to the market mess of things earlier this month.
Yeah, that's right. Basically saying if things follow our forecast, we're going to keep tightening financial conditions, which is
no problem for stocks over here.
Hopefully not yet. But as we've seen, global central bankers are very sensitive if stocks sell off, so it's okay. Self-correcting.
Do you think that they're sensitive? Are they as sensitive to that story?
They're probably more sensitive to the yen than they are to the Nikkei, if I had to guess. But I think they're probably, to some degree, have to be sensitive to market price action these days.
Dollar yen at about 146, negative on the session by 0.1%. Under surveillance this morning, Boston Fed President Susan Collins and Philadelphia Fed President Patrick Harker both saying in Jackson Hole that it's appropriate to begin lowering interest rates soon, adding that the pace of cutting should be gradual and methodical. Their comments coming ahead of Chairman Powell's speech at 10 a.m. Eastern Time. And Stuart, if you reflect on what we've heard from Harker, Collins, Schmidt yesterday sitting down with Michael McKee, there is no urgency whatsoever at all. And when I hear that, I don't hear these guys drifting towards 50. It sounds a lot like 25.
I think that's right, but they also want to send a message of gradual slowing the labor market, because that's what they're trying to accomplish. And there's no benefit for them to start getting very stressed in their commentary, right? It just creates them more problems. So I mean, they have a base case forecast. They're going to try to stay loyal to that, and they're going to try to guide the market to stay loyal to that, to keep things copacetic.
Chairman Powell's going to be talking about how effective monetary policy is. That's kind of the title of this month's event. If we were doing this maybe a year ago, would we be talking about monetary policy that wasn't tight enough? How do we know we're sufficiently restrictive? What are we gauging that on? What are we basing it on at the moment?
I think it's a great question. A year ago, if you mentioned earlier, a year ago, the Jackson Hole commentary was very, very aggressively negative, right? And then by December, they were all of a sudden starting about they might need to start easing policy. So as we can see, the posture of these comments can change pretty quick. So let's just focus on the meeting we have before us.
December meeting 23 was strange. We talked about cutting interest rates, and then New York Fed President John Williams comes out the following day and says, we're not talking about cutting interest rates. What do you make of the conversation, the communication we've had out of this Federal Reserve recently? Let's just take, for example, the last meeting, end of July, and the daylight seemingly between the chairman and what we saw in the minutes. Do you think the chairman's doing a poor job of reflecting consensus on the committee, or are they just massaging the minutes by such an extent that it kind of looks divorced from what we heard just a few weeks back?
Well, I mean, you asked about dissents earlier. Powell seems to be very intent on not having dissents and is very good at managing that. But once you get out of that room, people are gonna say what they feel, I guess. And I think that's happening. And you could, if you were more Machiavellian about it, you might argue that they're sometimes testing narratives and they want to kind of see how things respond and kind of read and react that way as well. But I think it is a Fed that wants to show unanimity after the issues they had with maybe being too late to start hiking. And unfortunately, people are people and they have their personalities and they get out in the world and they say what they feel.
We're focused on one personality a little bit later, Chairman Powell, 2 hours and about 30 minutes away. Let's turn to the latest from Uber. Uber is planning to start offering self-driving cruise cars to customers next year. The partnership, coming as Cruise, owned by General Motors, has begun trying to regain traction after regrounding its fleet last year, following the mishandling of a collision with a pedestrian. Your next story from NVIDIA, preparing to report earnings on Wednesday. Bloomberg Intelligence expecting the chip maker to beat consensus estimates and raise guidance for the third quarter. But concerns about the Blackwell chip delay could weigh on expectations for 2025. We've got Mandeep Singh of Bloomberg Intelligence around a table with us. Mandeep, good morning.
Good morning.
Expectations for next week. How high is the bar for NVIDIA this time?
Actually, not that high, but when you look at the history of what they have done in the past 3-4 quarters, there will be at least a $2 billion beat and raise, as they have done. But the magnitude of the beat will get smaller now because their revenue base is much larger. So the data center revenue expectations are $100 billion for this year annually. Now, a $2 billion beat and raise per quarter doesn't seem that high than it did, 4 quarters back when the revenue run rate was half of that. So clearly, I think no matter what they do, the numbers won't look as big as they used to, but I think the tailwind is behind their back. What we have heard from hyperscalers this quarter is they're planning 30 to 40% CapEx increases going into next year. That's very positive for NVIDIA because it's still 50% of the revenue comes from those 5 hyperscalers.
There's been some discussion about back half of this year because you have the Blackwell rollout that people might kind of wait for that, that chip to get introduced. What do you expect the discussion around that to be?
I mean, look, the market is still supply constrained right now. Whatever chips NVIDIA is making, they get bought because of the supply constraints. And whether it's Blackwell or an earlier version of the chip, right now we are in that phase where every company wants to pilot something with generative AI. And there is the only game in town is NVIDIA. So I don't think there's any problem when it comes to their product dominance or their market share. I mean, we know Intel is struggling. And to me, it's really about 2027. And I hate to say, I'm looking that far ahead, but that's what you have to do because consensus is extrapolating these growth rates 3-4 years out. So if market is assuming they're going to do $100 billion in free cash flow, what is embedded in that? Gross margin of mid 70%. Now, can they keep that going into 2027? Because that's how high the expectations have become. And I think that's where I do think there is some risk because you can't assume a chip company having a recurring revenue run rate the way market is pricing right now. I mean, it's not a software company at the end of the day.
And so where is the supply chain these days? I mean, is the supply chain as long as it was 6 to 12 months ago, or have they started to kind of eat away at it a bit?
So TSMC gives us monthly data points, and what they told us last month was, their revenue grew 45%. So clearly, they are expanding capacity. They're seeing that demand. And a lot of that is helping NVIDIA because no matter how many chips they make, they get sold. So clearly that's helping, but there will be a point, again, I hate to look at 2027, but that's where you have to look at where there will be equilibrium and where the prices will settle because right now that supply constraint is what's really driving the NVIDIA growth rate and it will continue to drive at least for the next few quarters.
I think to some degree, Mandeep, and you've been on top of this story, we need to explore things further downstream. We know where the demand is coming from, we know which companies the demand is coming from, and we need to gauge how much patience investors have with those companies to carry on making the investments they're making without the use case really being demonstrated in a major way. How much patience do you think is left from investors for the big customers out there, the Alphabets of this world?
Yeah, I mean, look, I think this quarter, every company that raised their CapEx was cheered. Even Meta was cheered when they talked about raising CapEx. So for now, I think investors are okay because they do see some proof points. But you're right, that is a risk. Whether investors will cheer that for 2026 and beyond. And right now, it's too premature to think these companies will continue to raise 30, 40% CapEx going into 26 and 27 because that hurts their free cash flow. So in the end, all the spend that's going is hurting the free cash flow of these companies, the hyperscalers, and it's translating into NVIDIA's revenue. And
I've heard some people draw some parallels between where we are now and the investments that were made into the cloud business coming out of GFC. Do you see the same parallels? Some of the complaints we're seeing about over-investing in this. And I can sense just from the earnings calls over the last few weeks, over the last few months, that the CEOs themselves are starting to sound a little bit more defensive about the investments they're making. If I pick out Sundar Pichai over at Alphabet, for instance, he had to really come out and very sternly say, the biggest risk here is under-investing. Yeah. You want to over-invest, if anything. Are there parallels between where we are currently and where we were 15 years ago?
There absolutely is. And look, this is a super cycle. This is the hottest growth segment right now in tech. And that's why everyone feels it's okay to overinvest, because one of Sundar Pichai's point was also, we can allocate these chips for some other kind of workloads. Even if we don't use them for generative AI, we could use it for some other type of processing. So it's not as if, you know, you're over-investing now, and if the use case doesn't translate, the chips go waste. You can still keep using the infrastructure for something else. And that's what Mark Zuckerberg highlighted as well. And also the size of the models keeps getting bigger. The question is, how bigger does the next model get? Llama 4 or GPT-5, is it going to be 10 times bigger, or is it going to be 2 times bigger? Because if it's 2 times bigger, then probably you don't need as much chip capacity as everyone is expecting. But if it's 10 times bigger, I mean, we've got a long runway here. And I think NVIDIA will continue to reap the benefits.
You mentioned TSM. I mean, is this an NVIDIA event, or is this an event for semiconductors at large? And will AMD and some of these others kind of be caught up in the story as well?
I mean, right now it feels like the dominant player continues to have that lead, and that's why an AMD or Intel is struggling to catch up. Same thing on the foundry side. TSMC has a clear lead. Everyone else is like a distant second and third. And that will remain. I mean, that's the thing with semiconductors, is once you establish a lead, you've got a long runway. We saw that with Intel back in the day. And that's what NVIDIA seems to be replicating. The question is, how much transfer is happening from legacy spin to Gen AI? And in this case, you know, NVIDIA seems to be benefiting from that transfer in addition to the incremental dollars, because I mean, they grew data center revenue triple digit when hyperscalers weren't spending as much on CapEx. Now they are increasing their CapEx by 30, 40%. They weren't in the last 12 months. Still, NVIDIA grew triple digits.
They're a clear and obvious winner. We'll catch up with Mike Wilson of Morgan Stanley in about 30 minutes. Morgan Stanley has drawn a distinction between AI enablers and AI adopters. NVIDIA is the winner of the AI enablers. Of the AI adopters right now, can you identify who's in the lead and who's winning?
I mean, Microsoft, by far.
By far, what are they doing that gives them that lead? What have they done?
Just the cloud ramp up, what they did with OpenAI in terms of deploying OpenAI on their cloud, the Copilot revenue they have shown in every earnings, it's growing triple digits for them. And they are in that very early phase. I mean, think of NVIDIA, you know, 6 quarters back. That's where Microsoft is with their Copilot ramp up. And that's where I think they have a clear winner's strategy.
Apple likes to be late and better. Do you think they can be late and better?
I think the fact that they don't have their own large language model, that's what gives me a pause. Apple's strategy is, yes, we have the distribution. We'll use everyone's large language model and deploy it on our phones, but not owning the IP is what, I mean, what Apple has traditionally done well is they vertically integrated. They own their chips.
Yep.
They owned everything in the phone. So not owning the large language model, to me, that's a concern. But clearly, they have demonstrated that they can come back and show a winning strategy.
Apple up by 0.7%. Mandeep's going to be on TV a lot next week, looking ahead to those NVIDIA earnings. Mandeep, good to see you. Thank you, sir. Mandeep Singh there of Bloomberg Intelligence. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Johara Hackers.
Hi, John. The BOJ is sticking with its hawkish stance as it unwinds years of ultra-easy policy. Speaking earlier today, Bank of Japan Governor Kazuo Ueda said policymakers can add to hikes they made in March and July if the economy and prices are in line with their expectations. As a result, you're seeing the yen strengthen against the dollar. Meanwhile, former President Donald Trump is threatening large tariffs on countries that don't accept deported migrants. Immigration remains a cornerstone of Trump's re-election pitch, while imposing large tariffs on both adversaries and allies is also a key part of his economic policy. Trump visited the U.S.-Mexico border yesterday as he intensified his attacks on Vice President Kamala Harris and her handling of illegal immigration, all part of his effort to reclaim Arizona. And in the latest twist in the Paramount saga, Skydance Media is accusing Paramount of breaching the terms of its deal by continuing to engage with another suitor. Skydance says Paramount didn't provide written notice of the extension of the so-called go shop period and says the extension isn't valid because Edgar Bronfman Jr.'s proposal isn't superior to the Skydance Media offer. That's your Bloomberg Brief. John?
Yahara, thank you. I know it shouldn't be this way, but there are certain stories that just give you a headache, and that's one of them. And I'm just trying not to talk about it. Are you following this story? This drama? You avoiding it?
I'm avoiding it, and just you should never date two people, Jonathan. That's really the takeaway.
There we go. Great advice from Stuart Kaiser. Okay, for those that need it. Up next on the program, the frozen housing market.
Even if rates were to stay at current levels, at some point, folks are going to adjust and the transactions are going to pick up. And we need that to happen. The existing home market is essentially dysfunctional at this point. It's frozen.
Unlocking that frozen market up next.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This just came from Michael Harnett of Bank of America. Weaker Main Street, fragile Wall Street, slowing China, all of that equals treasuries are the best hedge for Q4. Priya Misra, JP Morgan, coming up a little bit later. Priya's going to have some thoughts on that. Your bond market at the moment going into Chairman Powell, 384.63 on 10s. In the equity market, just elevated a lift here, up 0.5%. Crude participating, a rally there, up by 1.8%. WTI 74.32. Under surveillance this morning, unlocking a frozen housing market.
Even if rates were to stay at current levels, at some point, folks are going to adjust and the transactions are going to pick up. And we need that to happen. The existing home market is essentially dysfunctional at this point. It's frozen. We're at under 4 million units. That should be closer to 5.5 million units. And remember, at the other end of an existing home sale, there's typically a home purchase, and that could be a new home purchase. So it's not a zero-sum game here.
Here's the latest on this front. US mortgage rates dropping to a new low this year as potential home buyers await Fed rate cuts. The latest data showing small but still weak existing home sale gains ahead of new home sales coming out later this morning. Ryan McKeveny of Zelman & Associates saying this: the market is currently chopping along with the bottom at some of the weakest existing home sales levels since the great financial crisis. But we expect to see improvement later this year and more so in 25-26. Ryan is with us now for more. Ryan, can we talk about what is funding the purchases that we see at the moment? Can we start there? Do you have any stats on the amount of cash buyers in this market at the moment? Because earlier this week, mortgage applications dropped off a cliff? How much of this is just very wealthy people with access to a lot of cash?
Hey, John, thanks so much for having me. That's definitely a component of things. The latest data suggests coming up on 30% of all transactions are cash buyers. It's up from a year ago. It's actually at the highest level since 2014. So you led into this with the overall weakness in existing home sales, which is true. But there is a bit of a dichotomy where the high end of the market, sales occurring above $1 million, and that cash buyer who has the ability to forego a mortgage with a high mortgage rate, they're active in the market, and the people who are being pinched, unfortunately, are that lower end consumer who's really struggling with affordability.
So, Ryan, do you think there are big cyclical signals right now in the housing market, or are these just sort of permanent structural issues of the last several years?
I would say it's mostly cyclical. The impact of rates tends to be the biggest factor, again, to that affordability dynamic. The home buyer who's attempting to leave a rental to get into home ownership, payments have gone up very meaningfully. It's not just that interest rates are 2x what they were a few years ago. Home prices have gone up very meaningfully. So I would say the cyclical aspect of things really ties to mortgage rates. The good news with that is we have seen some reprieve more recently. We're now around 6.5% on a 30-year fixed mortgage, down from close to 7% just 2 months ago. So moving in the right direction. I think to the extent we continue to see improvement in mortgage rates, you can expect some cyclical improvement in the housing market and home sales.
Brian, what are you seeing from lenders in terms of maybe innovation and different ways of kind of packaging up the product to get people involved? I think I heard, folks were embedding free refis in some of the mortgages. What are you seeing on that side of things?
Yeah, that has been a play of some of the lenders. Hey, buy with us now. We know it's a high rate, but we'll cut the cost of a refi when rates move lower. That has been happening. There's also been some programs, lower down payment requirements for certain buyers. Now, there are challenges with those because oftentimes the subset of buyers that are able to qualify might be in a price point or might be at an income level where it's still very aspirational. They're still not at that point to be able to get into the home and afford the monthly payment. So there is some innovation. I would say it's more on the margin. But yes, there are lenders attempting to help solve the affordability problem to the extent they can. The other side of the coin with that, where there has been a meaningful change, home builders, in terms of new home sales, have been offering mortgage rate buydowns. I wouldn't necessarily call that an innovative product, but it has definitely moved the needle, and there's been a lot of share gains in the new home market compared to the existing home market because those builders can buy down that mortgage rate and make it more affordable for their consumer.
Ryan, as you know, the focus on Wall Street for markets worldwide today is on a speech from the Federal Reserve Chairman at 10 a.m. Eastern Time. There's a big focus on whether he cuts by 25 basis points in September or by 50. I think we'd love to gauge from you, just to get a decent idea of what difference 25 or 50 would actually make. And if we can spend a little bit more time on the lock-in effect that we're seeing at the moment in the housing market. As you know well, our audience has followed this as well. The effective mortgage rate, so the average rate right now for outstanding mortgages is something like 4%. And as you mentioned, the market rate is a little south of 7%. So we've got a big spread and no real incentive for people to sell a home, particularly for those that have got a two-handle on their mortgage. How much does that spread, Ryan, need to close? How many rate cuts do we need from the Federal Reserve? What would actually change that lock-in effect, that lock-in story, and get some inventory back in the market?
Yeah, it's a great question, John. A couple components to that. So in terms of the Fed actually cutting, a lot of that seems to be priced into the bond market already. So all else equal, we do think the Fed starting to cut is a positive for mortgage rates, but we think it's a modest positive. It seems to indicate to us that the 10-year Treasury yield unlikely to change very much, or at least that's what the bond market is telling us. The spread between short-term and long-term rates could compress. Generally, compression in that spread is beneficial, or let's call it a de-inversion and then steepening of the yield curve tends to be beneficial for mortgage spreads. Where we are today, if we think about a 30-year fixed mortgage against the 10-year Treasury yield, today it's about a 260 basis point differential. Long-term average, that's 170. So we're close to 100 basis points wider than normal on that mortgage spread. So as the Fed does begin cutting, and again, whether it's 25, 50, or how quickly this goes is anyone's guess. But we would expect that mortgage spread to slowly compress, and that's where we think the benefit to mortgage rates comes, as opposed to banking on some big change in the 10-year Treasury yield, for example.
Got it. So this is the trillion-dollar question, if I can follow up, Brian, and then you can follow on. I want to understand what it does to prices. Everyone does. Is this going to stimulate supply more than it does demand, or demand more than it does supply? And what do prices do?
Yeah, and that ties in greatly with your last question on the lock-in effect. What I would say is in 2024, even as rates have stayed high, mortgage rates have stayed high, you have seen the lock-in effect start to lessen. The number of new listings coming to market is up from a year ago. The amount of inventory on the market is currently up about 20% nationally. There's markets where it's up 50, 70, 90%. So even with high rates, you've started to see the lock-in effect ease. As rates move lower, more supply probably does come to market. It also does unlock demand. So we're in a bit of a tricky period. Our view is home prices do continue to move higher, but the rate of growth is below average going forward. So we've been in a period where home prices went up 15 to 20% back-to-back years in the beginning of COVID. Last year, they were up about 6%. That's above average. Typically, they're up 4% in a given year. We think home prices are probably going to rise about 2%, 2 to 3% the next couple of years. So it will be a combination of both supply coming back to the market, but also certainly some unlock of demand if we do have lower mortgage rates.
Awesome. Ryan, thank you, sir. Ryan McKeveny there of Zalman and Associates. Got to do this again soon. Stuart, it's a big question, I think, for the Federal Reserve as well. Is this inflationary or disinflationary if they start cutting interest rates?
I mean, their view, I guess, is it's inflationary, right? I mean, if they believe high rates gets inflation down, then you have to believe, low rates gets inflation
Housing market's been an odd beast, though, right?
It has. It's a unique thing just because we have those longer dated fixed rate mortgages. If you talk to investors in Europe or Australia or other parts of the world, the higher rates have actually really eaten into demand for other goods as well, in a way that because we have that low effective mortgage rate locked in, it just hasn't affected the U.S. the same way.
UK mortgage market is a very, very different beast. Stuart, this was fun. 2 hours flies by.
It does. Thanks for having me.
It's good to see you, sir. Thank you. Stuart Kaiser there of Citi. Coming up on this programme, we'll catch up with Priya Misra of JP Morgan Asset Management, Mike Wilson of Morgan Stanley, Sarah House of Wells Fargo. That's your lineup for the third hour of Bloomberg Surveillance. Going into a big address from Chairman Powell at the Jackson Hole get-together in Jackson Hole, Wyoming. We'll catch up with Lisa Abramowitz and TK in about an hour from now as well to get you a preview of that address. From the big man at the top of the FOMC, we've heard from 3 officials already, and there is no real sign of urgency to reduce interest rates. You just get the sense over the last few weeks, this is a committee getting closer to an interest rate cut in September, but the conversation on Wall Street has gone beyond that. It's talking about 100 basis points of cuts for 2024 and maybe even 50 on September 18th. The calendar, before we get to September 18th, we've got payrolls on the 6th, CPI on the 11th. So a lot of work to do between now and then. The next hour of Bloomberg Surveillance, up next.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are 3 fundamental things. Number 1, they do everything in teams. Their operations, their patients they see is all team focused. Number 2, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number 3, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow.
And these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. The top names in global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We're still on the path for a soft landing.
A policy rate closer to 3.5% to 4% is probably where we should be trending.
When we think about rate cuts, we're thinking one a quarter for 8 quarters, not one a meeting.
The Fed, in my opinion, is going to go very slowly.
Bond markets actually are running well ahead of even what the Fed may say coming up to Jackson Hole.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So let's go back to Chairman Powell, August 22nd, 2022. And we're sitting there, and I've got Lisa and TK either side of me, and we throw over to the chairman for his speech. We're thinking it's going to go about 20 minutes. It lasts 8 minutes. And there's one big takeaway. It's one word. The word is pain. And the quote, the big takeaway that we repeated for the next 12 months, went like this. While higher interest rates, slower growth, and a softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses. The chairman went on to say, these are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. Again, pain. Think about where we were 2 years ago. CPI running at about 8%, unemployment running about 3.8%. This Federal Reserve, this central bank, was a single issue central bank. In that moment, it felt like it was a single mandate central bank. 2 years later, this is how things have changed. CPI's come down from about 8 to around 3. Unemployment's gone from about 3.8 to 4.3. And that change means this view from this central bank is more balanced. It's a dual mandate, full employment with a price target of about 2%. And it's that balance that a lot of people anticipate from the Fed chairman when he speaks in about 2 hours' time. Going into that address, your scores look like this on the equity market from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now. Equity futures up by 0.6% on the S&P. On the NASDAQ 100, up by 0.8. The Russell, the small caps doing okay, up 0.5%. Your main event from Jackson Hole, Wyoming, just 2 hours away. The Federal Reserve Chairman addressing the annual get-together for the Federal Reserve, but in many ways addressing markets worldwide. 10 a.m. Eastern, 3 p.m. in London, 10 p.m. in Hong Kong. Talked a little bit about the price action. I want to turn to the bond market as well. The cross-asset check, the 10-year 3.85, a 2-year a little north of 4 after jobless claims came in okay yesterday for a third consecutive week. In the FX market, a euro about 111.20, but the dollar weakness has been a key theme of this market for much of the last month. Your lineup for the next 60 minutes or so. Coming up, we'll catch up with Priya Misra of JP Morgan Asset Management as investors prepare for Fed Chair Jay Powell's comments from Jackson Hole. We'll speak to Mike Wilson of Morgan Stanley on a data-dependent equity market and Sarah House of Wells Fargo on the risk shifting to labor. We begin with the big issue. Traders placing their bets ahead of Fed Chair Jay Powell's comments from Jackson Hole at 10 a.m. Eastern Time. Bloomberg's Mike McKee is on the ground for more. Good morning, Mike. What are you looking for?
Well, we're not looking for 8 minutes, that's for sure, John. We're looking for a kind of standard speech from the Fed chair that doesn't really break a lot of new ground. I think he's probably just going to essentially repeat what he's been saying for some time now, that we are seeing progress on inflation. It's enough to give us some confidence that inflation will get back to our 2% target so we can soon begin to adjust interest rates. Now, I don't think either that he is going to give us any kind of magnitude for that adjustment because they still have some data coming in September. If it comes in as expected, probably 25 basis points, but they leave their options open for 50 if we were got some bad numbers on especially the labor market.
Mike, do you sense that this Federal Reserve and this market, as is typically the case, are in very different places? We've heard from a few officials in the last 24 hours, from Harker, from Collins. You spoke to Schmidt of Kansas City. They didn't give me the impression there was any real urgency to reduce interest rates.
No, there's not a feeling here that that needs to be sort of an emergency priority. The feeling is that the economy is strong and could withstand interest rates staying where they are. They may not be appropriate for where we are, but as inflation goes down, real rates go up. So they have to move at some point, but they don't need to do it in a sort of intermediate emergency way. There is a sort of feeling that they have gotten a soft landing, although they won't use that term, but that unemployment is still low, even though it's gone up. Inflation is falling, and growth is still strong, stronger than they expected. Now, when you look at futures, I think you get a lot of people who are betting just in case, maybe hedging the idea of a 50 basis point cut, but the Fed officials I've talked to don't think the markets are necessarily way out of line right now, the equity markets or the bond market.
TK, quick question, or rather Mike, quick question. Did TK make it out of bed? That's what we all want to know. Has he made it to the set?
He did. He is drinking coffee behind me, so he will be here.
All right.
Along with the mountains, they'll show up too.
You tell him to behave. Mike McKee, thank you, sir. Waiting for TK and Bramo in about 40 minutes' time. They're going to join this program. Sun's going to come up. It's a beautiful view. If you've ever been, it's absolutely wonderful. Look out for that in about 40 minutes' time. Priya Misra of JP Morgan Asset Management joining us for the hour on this program. Priya writing the following: I will be watching closely if Powell provides context around cuts. Is the Fed cutting due to the normalization of inflation, or is there an element of risk management due to the slowing labor market? Any mention of the latter will keep the possibility of a 50 basis point cut alive. Priya joins us for more. Priya, it's good to see you.
Thanks for having me.
Thanks for being here. So Mohamed Al-Aaron was on the program yesterday. He said maybe this rate market is overdoing it a little bit. You actually don't think 100 basis points of cuts is overdoing it. Can you walk us through your framework for thinking about current market pricing and whether the Fed chairman will validate some of that a little bit later this morning?
Sure. So, you know, the market ultimately prices in essentially a distribution of outcomes. So if we stay in a soft landing, I think then they're really going 75 basis points. So you might argue that the market might be overdoing it. But what if growth, the slowdown that we've seen, I think there's no question that growth is slowing, the labor market's slowing. If we slow below trend, then the Fed's telling you, I mean, we don't have to actually read between the lines. They're telling us, if the economy slows down more, we're going to cut faster, we're going to cut more. So the market's essentially pricing in, I would say, 20% chance of a recession. So as they price in all these outcomes, I think 100 basis points is risk management from the market. Now, does the Fed tell us that they're in risk management mode? I think there's some elements of that you can sort of see in the minutes. You know, we always have to think about what do we hope the Fed tells us, what will Chair Powell actually tell us? I hope he talks about risk management because, I mean, what is Jackson Hole about? It's about transmission and effectiveness of monetary policy. That's the topic. The one thing we've learned through the hiking cycle was those lags are long, variable. You know, effectiveness is unclear. There's all these supply issues that might have helped inflation. That immaculate disinflation that we've had, well, they have to protect that. And as they start thinking about risk management, that's where I think that 100 is doable. Also, you know, they're talking about this gradual pace. Over time, I get it. But maybe they should, policy is extremely restrictive. Maybe they should cut a little more aggressively initially, get to some level of neutral, and then finesse it. I don't know if we're going to hear that, but I think that's what the market's really hoping to hear.
Yeah, as you mentioned, sometimes there's a massive spread between what we want and what they actually deliver. You said they're extremely restrictive. Can we just sit on that for a moment? What are you looking at that tells you that those lags are really actually starting to bite into this economy? Where in the data set, where from the corporate communication, what stands out for you?
Sure. So I think it's across the board. You're seeing inflation come down. You're seeing the unemployment rate go up. Now, the big debate has been, is it all supply-led? And I think there's some aspects of supply, absolutely. Supply chains have improved. There's been significant immigration boost to the labor supply. But when I look at, job hiring intentions, you look at JOLTS, you look at the quits rate, that started to come down. There are elements that the labor market is slowing. Now, I think the debate for the market is, are we slowing to trend or a little below trend? That's the soft landing. Do we continue to slow? And we know monetary policy works with a lag. I think the issue with a lot of macro people like me is we look at aggregate data, and the aggregate data has been okay. You start looking, but I would say the economy is extremely bifurcated. You start looking at low-income consumers. I would even argue middle-income consumers. They're essentially trading down. You start to look at small businesses. There's some element of slowdown. So it's made me not restrictive in aggregate. It's absolutely restrictive. Look at the housing market. You were talking about how it's frozen. I think it's restrictive there. We're going to need a lot of cuts for the housing market to unfreeze. I don't think 50 or 25 is going to do it. You're going to need 200, 300 basis points.
I've sat here, my head spinning, not because of this conversation, just the conversations over the last month or so, and I'm sure your head's been spinning too. 3 weeks ago was growth scare. They need to cut quickly. And there were some economists, some respected economists, coming out and saying they need to go 50 immediately. 3 weeks later, everything's changed. If I go back to the start of July, Chairman Powell was in Sintra, Portugal at the ECB's get-together, and he pointed to the strength of the market as a reason to have patience. The strength of the labour market gave them time to get this right. The comments that he delivered in early July, can he deliver later on this morning? Can he point to labour market strength and tell everybody that he's got time, and that's a reason to be patient to get this right?
So I'm glad you bring up Sintra. And the Fed is saying they're not data point dependent. So you could actually argue that, no, he shouldn't change his view. But here's what I struggled with that Sintra message. They told us, Chair Powell told us, that the labor market is back to where we were in 2019. And they just needed a little bit more confidence on inflation. Look at where monetary policy is in 2019 versus today. Real rates, about 150 basis points higher. Nominal rates, Fed funds was 175, it's 5.5. So I struggled when I heard Chair Powell at Sintra. I said, why is the market not pricing in very quick cuts? Why isn't the Fed cutting rates fast? Now, they're never going to cut 200 in a go. But I think this is the argument of start early, maybe start a little aggressively. I can see them go 50. What's the bar for 50? I don't know if we're going to hear it because we do have a lot of data between now and that September meeting. But is the bar that high when, policy is that restrictive?
We need to talk about the price of the story in the bond market as well. There's a lot of Fed talk. Let's get to the price in the bond market. This came from SocGen. I'll share this quote with you. They say the short-term rates market is pricing in an imminent recession with 125 basis points or so of cuts by January. We expect a more gradual cutting cycle as the risks of the Fed remain balanced between inflation and employment, kind of conversation you and I are having right now. They go on to say this about Treasuries, Priya. Treasury bonds performed admirably as portfolio diversifiers during the recent sell-off in equities. However, we see limited room for sustained rallies from here. What would you say to that?
I don't agree. I think in a soft landing, yes, the 10-year should probably be 3.5, 3.25, something in that. Because where does the Fed end up? Probably close to 3% in a soft landing. What happens in a hard landing? What happens if the economy does slow down? These lags take a while. So at that point, the Fed's going to cut into accommodative territory. That's 2%. So I would argue the hedging property of treasuries, it's worked. It's going to continue to work. If risk assets struggle, the only game in town is going to be treasuries because the Fed's going to be cutting then aggressively. You're going to be hearing 50. Dare we say 75? I mean, they hiked in 75 increments. They can absolutely cut aggressively. They can cut too. I think, beyond the 25, 50, let's look at the end point. So I struggle with the market pricing and the argument that the market's pricing in a high chance of a recession. Where's the end point? It's little above 3%. We can argue maybe our star is not 0 and maybe neutral rate is not 2.5, it's 3, 3.25. Well, we're pricing that in. We're not pricing in accommodative policy. When the market starts pricing in 2% endpoint, then I'll tell you recessions in the market. We're not there. We're pretty far from there.
Priya Misra of JP Morgan is going to be sticking with us. Your 2-year around 4%, the 10-year at the moment about 3.85. Let's get you some stories elsewhere with your Bloomberg Brief. Here's Johanna Hackers.
Hi, John.
Vice President Kamala Harris formally accepted the Democratic nomination Thursday night, Harris vowing in her acceptance speech to prioritize a fight for the middle class and reproductive rights, capping this week's Democratic National Convention. The Democratic Party is looking to seize on recent momentum created after President Joe Biden dropped out of the race, an unprecedented move in modern U.S. politics. Meanwhile, Wall Street is still fuming after the Bureau of Labor Statistics botched its Wednesday release of critical jobs data. Annual jobs revisions were expected at 10 a.m. Eastern, but the data wasn't publicly released on time, causing chaos and confusion across markets. The numbers were finally released around 10:30 a.m., but employees of firms like Mizuho and BNP Paribas got a hold of the data earlier by picking up the phone and calling the agency. A BLS spokesperson telling Bloomberg their inspector general will investigate, but Wednesday's incident is just the latest BLS mishap. In May, CPI data was inadvertently published 30 minutes early. And Southwest Airlines is looking for customer feedback on potential changes to its free checked bag policy. The company is surveying passengers about hypothetical scenarios involving bag fees for lower cost fares. Bloomberg obtained a copy of the questionnaire where customers are also asked about their booking preferences and travel habits. Southwest telling Bloomberg the survey doesn't signal an imminent shift, but it does come as the airline is changing its free-for-all seating policy, but that's as a result of pressure from activist investor Elliott Management. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the morning calls, plus Mike Wilson of Morgan Stanley on the equity market, going into that address from Fed Chair Jay Powell a few hours away. From New York City this morning, good morning.
Countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The opening bow 1 hour and about 14 minutes away. Equity futures on the S&P 500 up by 0.5%. Yields just about unchanged. Things are steady, 384.44. Let's get you some morning calls. First up, Guggenheim upgrading Roku to buy. The analyst saying the company is closing the gap between platform engagement and advertising sales growth. The stock is up by 4.7%. Your second call from RBC lowering its price target on Williams-Sonoma to 147. The analyst adopting a more cautious top-line outlook, saying margin upside feels pretty limited. The stock is still higher by 1.5% this morning after a pretty difficult day in yesterday's session. And finally, Wedbush raising its price target on NVIDIA to 138 from 120. Analyst Dan Ives saying next week will be, quote, and his quote, the most important week for the stock market this year and potentially in years. don't know if you think that's hyperbolic, but that's Dan Ives for you. As NVIDIA prepares to report earnings on Wednesday, that stock is up by 1.3%. Mike Wilson of Morgan Stanley joins us ahead of the most important earnings print in years. I'm not sure, Mike, if you'd agree with that. I will ask you this, though. What is more important, Mike, for you? This address from Chairman Powell a little bit later this morning, or that payrolls print on September 6th?
Yeah, good morning, John. I think, in my mind, it's about the payroll number. It's really about the labor data, period. That's what's going to dictate what the Fed does. They've said that, and that's what the market's going to trade off of. I mean, if you go back a month ago, that's when we had this correction, and it really did kick off with a weaker non-farm payroll number. Now that has been somewhat refuted by better claims, and also just, you know, the deal that jobs are okay still, but then we got the revision. So the data is still very mixed in my view. And the market under the surface, as we like to look at it, is still trading very defensively. It doesn't know. So I think it comes down to that payroll number. The Fed will react, and we'll see. And we'll see how the market goes. I mean, my general view is if they cut 25, that's probably fine. If they cut 50, historically, that has been a bad signal for the equity markets.
Mike, you say the market's traded pretty defensively. I want to pick up on that, just build on it a little bit. In some places, we've started to see that breadth improve again. Small caps have started to perform. We've seen the record highs on the equal weight through this week so far. Mike, do you think we're just as vulnerable as we were at the start of the month to weak data, or have we reset things differently this time around?
I think we're more vulnerable to another negative data point on the labor market. That was sort of a warning sign. And once again, we don't know the result, but if we get a negative payroll number, I think the market could react just as bad at the index level. So let's talk about that under the surface. I mean, you mentioned small caps have done better. Well, they did better in July when the money rotated away from the Magnificent Seven and some of the quality growth leaders, and it went into defensives, quite frankly. So defensives have now, and when I say defensives, I mean utilities, healthcare, staples, and real estate. Those four sectors have led on a 5-day basis, on a 1-month basis, and a 3-month basis. So it's been very consistent. And that's about the time we pivoted back in May to a more defensive book. And I don't really see any reason to kind of deviate from that. Now, if we get a very strong payroll number, then that trade is going to reverse sharply back to the more cyclical parts of the market. I think it's going to be very messy. I don't anticipate the labor data to improve dramatically. I don't know if it's going to deteriorate further. But given the signal from the stock market and the bond market, quite frankly, the markets are definitely paying attention to this, and this is a big number.
Mike, if I can ask, what probability of a recession do you think the equity market's essentially pricing in? And you can look at breadth there, or you can look at aggregate. And the other question was on margins. How do you see that evolving? Because I felt margins had a nice tailwind with the fact that that essentially cost of input prices were coming down. Does that change? If prices are going to be more stable, it's all going to come down to those sales numbers. So I guess 2 questions.
Yeah, we'll start with the second one. I mean, I think you're dead right on. I mean, what the micro data has been definitely weaker than the macro data. And let me just take a minute on this. This kind of goes to my core thesis that we basically have a policy mix, call it fiscal dominance, where fiscal policy has been really the dominant lever for the last couple of years. That's what led to the inflation breakout, in my view. There were some supply constraints, sure, but basically we had too much aggregate demand from fiscal stimulus. And now that has somewhat prevented the Fed from being more proactive with rate policy. And in effect, it's crowded out, as you were mentioning earlier, it's crowded out the middle class, it's crowded out the lower class, lower income class for sure. And even some of the wealthier investors now are being crowded out. And that's why small caps have underperformed so much. So that's very much intact. And I think that that policy mix has been unusual. It has also extended, I think, the cycle longer than what it probably would have been, which has kept the Fed doing their job of keeping rates higher for longer. And now it's working. Now it's really starting to bite in the interest rate sensitive parts of the market, like housing, autos, and some of those areas. So overall, I would say that at the S&P level, it's not really pricing in a recession at all. I would say at the stock level, it's probably similar to where the bond market is. That's why we have defensive leadership. That's why small caps have been persistently underperforming. And it's probably in the 20% range or so. And that's what always happens, right? Until it's definitive, the stock market doesn't really want to go there, and it won't go there because it needs the hard data.
Thank you, which actually makes a lot of sense to me. We all see the same data. So this idea that the bond market might be pricing is something very different from the equity market. I mean, we're all looking at the data. We're all listening to the Fed. One point you made earlier that 50 basis points might be viewed negatively. And I see the point. What does the Fed know that we don't know? Why are they cutting 50? But if we hear from Chair Powell, and I don't know if we'll hear it today, but providing a context around potentially going faster initially, that if monetary policy is restrictive, they're just trying to reduce the level of restrictiveness. You think the equity market might like it, that they can be a little more aggressive initially so they're not behind the curve? I guess that was the learning from the hiking cycle. It would be to start earlier so you don't have to do as much. You think he can finesse that message and keep it in the normalization of 50 basis point cut?
Well, anything's possible for sure. I'm just saying, historically speaking, when the Fed is kicked off with a 50 basis point cut, it usually has led to, not a great outcome. That basically we're on the downswing on the cycle. Now, this cycle's been unique. They probably got higher than they initially planned. So maybe that sort of situation doesn't apply this time. So I'm open-minded to anything. All I'm saying is that if the Fed were to do 50, that means the data probably deteriorated more. Okay, that's really kind of where that comes from. And that would suggest that probably the labor market in particular deteriorated more. And that's how the bond market's pricing it right now, right? I mean, they're basically saying a 25% chance of a 50 basis point cut. That's not, that's much less than it was 2 weeks ago.
Mike, let's squeeze in some sector preferences as well. I know you're not a big fan of consumer discretionary based on the conversation we've just had. Industrials, how do they fit in? Why do you like that part of the market so much right now?
Well, I would say, we don't love industrials here. We're just saying in the in the cyclical bucket, you got to own something, right? You can't just be totally naked on cyclical exposure. And if there is one group that we would gravitate towards, it would be the industrial sector, that cyclical preference is there. Within technology, which is a cyclical group, I would say we would skew more towards software rather than semiconductors or hardware, simply because they're more defensive, but it is cyclical still. So those would be the two cyclical groups that we would like in conjunction with our defensive bias, which is utilities, healthcare, staples, and real estate.
Mike Wilson of Morgan Stanley. Mike, always great to catch up with you, sir. Looking ahead to the big one for them, not the Chairman Powell address later this morning, the bigger one for them, September 6th, the payrolls report for the month of August. Would you share that view as well, Priya? Do you think the data ultimately is the more important factor here?
It is. I mean, all we're going to get here today is really the reaction function and the risks around the outlook. So I am going to watch, what does Chair Powell say about risks? Are they balanced, or are the risks to the downside increasing? But it's ultimately the Fed's assessment or Chair Powell's assessment, the reaction function. That's all we're going to get today. Then we're going to look for ISM, as well as that all-important payroll report. And within payrolls, it's not just that headline number. The unemployment rate, I would argue, might be a little bit more important, because as we saw with the revisions, that payroll number you have to sort of take with a big pinch of salt.
Keep hearing the same date, don't we? September 6th for payrolls, just a few weeks away. Coming up next on the programme, Priya will stick with us. We'll catch up with Sarah House of Wells Fargo, ahead of Fed Chair Jay Powell, and the view on the labour market from New York City. You're watching Bloomberg Surveillance.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading.
You know, over the last few years, I think there's this issue of GPU production.
Yeah.
Right. So even companies that had the models, that had the money to pay for the GPUs, couldn't necessarily get as many as they wanted because there were all these supply constraints.
Yeah.
Now I think that's sort of getting less. So now I think you're seeing a bunch of companies think about, wow, we should just like really invest a lot of money in building out these things. And I think that will go for some period of time. I think there is a capital question of like, okay, at what point does it stop being worth it to put the capital in? But I actually think before we hit that, you're going to run into energy constraints, right? Because I don't think anyone's built a gigawatt single training cluster yet, right? And then you run into these things that just end up being slower in the world. Like getting energy permitted is like a very heavily regulated government function, right? So you're going from, on the one hand, software, which is somewhat regulated. I'd argue that it is more regulated than I think a lot of people in the tech community feel. Although it's obviously different. If you're starting a small company, maybe you feel that less. If you're a big company, you know, we just interact with people. Different governments and regulators are, you know, we have kind of lots of rules that we need to kind of follow and make sure we do a good job with around the world. But I think that there's no doubt that like energy, and if you're talking about building large new power plants or large build outs and then building transmission lines that cross other private or public land, that is just a heavily regulated thing. So you're talking about many years of lead time. So if we wanted to stand up just some like massive facility to power that, I think that's a very long-term project, right? And so I don't know. I think I think people will do it. But I don't think that this is like something that can be quite as magical as just like, okay, you get a level of AI and you get a bunch of capital and you put it in, and then like all of a sudden the models are just gonna kind of like I think you do hit different bottlenecks along the way. I think we would probably build out bigger clusters than we currently can if we could get the energy to do it. So I think that's
and that's fundamentally money bottlenecked in the limit. Like if you had $1 trillion.
I think it's time.
Yeah.
Right. Well, if you look at it in terms of, but it depends on how far the exponential curves go, right? Like I think a number of companies are working on, you know, right now I think like a lot of data centers are on the order of 50 megawatts or 100 megawatts, or like a big one might be 150 megawatts. Okay, so you take a whole data center and you fill it up with just all the stuff that you need to do for training, and you build the biggest cluster you can. I think that's kind of, I think a bunch of companies are running at stuff like that. But then when you start getting into building a data center that's like 300 megawatts or 500 megawatts or a gigawatt, just no one has built a single gigawatt data center yet. So I think it will happen, right? I mean, this is only a matter of time, but it's not going to be like next year, right? It's I think that some of these things will take, I don't know, some number of years to build out. And then the question is, okay, well, just to, I guess, put this in perspective, I think a gigawatt, it's like around the size of like a meaningful nuclear power plant only going towards training
getting all in, investment grade, high yield, high quality, high yield, securitized, you're getting 5, 6, 7% all in yields. So it's not too late. You're getting higher than money market rates. Money market, there's that regret factor that'll start to come in. Well, interest rates are falling. So it's going to take a while. I think in a recession, if things actually slow down, I think that money stays in the front end because people just don't know. But in a soft landing, which is our base case view, I think you're going to start to see the moment the Fed starts to cut and signal more cuts, we get the dot plot in September, that money starts to move out.
Are you noticing a change in the conversations with clients? Are those conversations changing, or are they stubbornly sitting there and saying, I'm going to wait?
They are changing. And I'll tell you, 2 weeks ago, which now feels like it was just a wobble, at that point it felt like the world was coming to an end. I mean, only joking a little bit here. But, you know, I think at that point, bonds were a hedge. Interest rates fell. I think a lot of people who might have thought interest rates were going to be a hedge a year ago were disappointed. We actually had a small preview of what happens if the economy slows down. Interest rates fall, the more cuts start to get priced in, all in yield. So even though spreads widen, all in yield on fixed income actually came down as the economy slowed down. So correlations were alive and kicking in front of you, and we've now heard it's not a hope trade. The Fed needs confidence. They're getting that confidence, so the Fed's going to start to cut. So I think that the conversation from clients is, okay, we want to put money out of cash. Where do we buy? I think that's more the question.
Things are slowly starting to change, and then all at once over the last few weeks. It didn't feel like the world was going to end unless you were positioned in the wrong way in dollar yen at a certain point. That Monday morning felt pretty brutal. We're counting you down to that Federal Reserve address from Chairman Powell at 10 a.m. Eastern Time. Sarah House of Wells Fargo writing the following. Powell may frame possible easing in terms of a risk management approach to policy. His speech is likely to hint that a rate cut is coming. We expect him to stop short of offering any clues as to the size of a potential rate adjustment. Sarah joins us now for more. Sarah, let's go through it together, and welcome to the program. We've heard from Federal Reserve Chair Jay Powell a few times over the summer. We had a meeting at the end of July. We had the minutes only this week. What's the next logical step in the communication from the top of the Federal Reserve?
Yeah, so I think it is going to be this increasing emphasis on the softening that we've seen in the labor market and how the risks are more balanced is what the Fed's been saying. But I think we'll be listening for, are those risks now balanced? Are they maybe even possibly tilted towards the labor market rather than inflation? And so I think it's that ongoing transition away from inflation and looking at the more balanced risk between the Fed's two mandates.
I remember a conversation that we had, you and I had, about a year ago about the difficulty of the last mile. Everyone was focused on it, the difficulty of getting from 4 all the way down to 2. We haven't yet completed that last mile. Sarah, have we given up on it?
I think there's been a little bit of an implicit giving up, to use your phrase, where I think, you know, in our projections, we only have inflation getting down to about 2.25%, but I think the Fed can live with that if it's weighed against the context of a potential downturn and actual deterioration in the jobs market. So I think when you look at how far they've come on inflation from over 7% to now 2.5%, that last quarter point or so, I don't think it's going to be a deal breaker if it means preserving the other side of their mandate.
Sarah, in terms of the unemployment rate, how much of that increase do you think has been about labor supply versus the fact that the economy, that the labor market might be slowing? I think that's the key as we sort of parse through the labor data, which we're all focused really on that September 6th number. How much do you think it's about labor supply versus demand?
Yeah, so we've looked at this and thinking about it almost in a SOM rule-like perspective, where how much of that increase in the SOM rule indicator has been driven by new entrants or re-entrants to the labor force versus those who are actually losing jobs. And we found that about half of it is due to the increase in entrants. So that's much more than what we would typically see if the economy was on the brink of a recession. But that said, that still means that you've seen a pretty noticeable rise in terms of unemployment from permanent job losers. So I don't think we can brush the rise in the unemployment rate entirely aside just based on the labor supply story. And I think you can also see that with just the weakening in demand indicators that we see, whether you're looking at job openings, small business hiring plans, the fact that temporary employment is now below where it was in 2018, even as we have a much bigger workforce. And so, yes, it's been supply, but it's also been weakening demand for workers as well.
Do you think we're going to hear this from Chair Powell in some way? I mean, you have to read between the lines, but this idea that maybe we don't have to keep the level of restrictiveness the same, but actually reduce the level of restrictiveness, where if they're worried about the demand side of the labor market, they have to want to reduce the level of restrictiveness. But you think they're there yet? Or are you there?
I think we're getting there, and so I think the Fed's getting there. I think, in our view, we're already there in terms of the jobs market is back to where I think the Fed wants it to stay. And so I think it's not so much the absolute state of the labor market that's a concern. Overall, the jobs market is still in good shape. It's the direction of travel that's concerning. And so I think when you look at that that direction of travel, and also just the overall state of the jobs market, how we do see it back to where it was before the pandemic, in some cases even more of a mid-2010 state. Still pretty good, but if the Fed wants to keep it there, they do need to start dialing back the degree of restrictiveness. So I think this is a speech where Powell can help explain how the Fed is thinking about its current policy setting and why some adjustments are warranted if they want to keep the labor market in good shape overall.
Sarah, does he use the word normalization? Does that come up? Is that what this is about? I think Priya's done a wonderful job this morning of drawing a distinction between normalizing things, reducing restrictiveness, and going back to something in the threes versus something like going towards accommodation because of much weaker economic data. How does he frame things today?
Yeah, so whether he uses the word normalization or not, I think that's the right idea. We've seen economic conditions normalize, so yes, inflation isn't all the way back to 2%, but we've certainly seen a normalization in the jobs market, and so the policy setting has to normalize as well, especially if we do think that inflation is a lagging indicator. So that softening we've seen in labor conditions, that's going to help squeeze out a little bit more of inflation and get it closer to the Fed target. So I agree, this isn't about stimulating the economy, it's just about taking the foot off the brake and making sure we don't overshoot our destination.
Sarah House of Wells Fargo. Sarah, appreciate it. Priya, when that word comes up, if it comes up, what's normal? What's normal compared to what normal was back in 2019?
Which Powell's going to say we don't know, and they're data dependent, so we have to all figure out what that neutral is in real time. Now, I would say our star, President Williams has said it hasn't really changed. I mean, who knows? Maybe there's some small increase. If the supply side of the economy kicked in, which it did, one of the reasons why we've been in immaculate disinflation is that the supply side worked. That would argue for slightly higher R-star. So I would say normal, neutral, close to 3%. And the market's essentially pricing that in. So that's why I struggle with this idea that the bond market's pricing in a high chance of a recession. We're pricing in that the Fed continues soft landing. And this is interesting because the Fed, soft landing cuts are rare. The Fed rarely has been able to engineer a soft landing, but we've gotten it so far. We're in a soft landing. And I think this is such a pivotal time. If they cut and they signal, they don't push back against the bond market, they allow the economy to get to those normal level of rates, that soft landing might actually continue. He'll go down as the best Fed chair.
Ira Jersey of Bloomberg Intelligence joins us now to complete that conversation. Ira Jersey, the potential of going down as the best Fed chair, it's not mission complete just yet. And it's unlikely we're going to hear him say mission is complete a little bit later this morning. What do you and the team expect to hear from him?
Yeah, I do think that he's going to signal that they're ready to ease, but they're going to be cautious about it. And I think that Priya's right that, he's not going to completely pre-commit. And certainly, he might talk a little bit about the developments of communication. And I think that could be something that's pretty interesting because with all the forward guidance that they're giving and with the dot plot and all of the forecasts and all the speakers that come out, there is a lot of noise and not as much signal as maybe the markets would like. And you certainly see, every time you have a Fed speaker in the market, you wind up seeing at least some volatility and some discussion just from what that one speaker is saying. And I think that we've lost kind of the narrative of the entire committee. So hopefully Jay Powell is able to say, okay, look, the committee thinks this, and here's our reaction functions. But at the same time, the economy is slowing meaningfully enough that a cut's a foregone conclusion. It winds up being how aggressively do they go after that. And the market has now priced for quite a few cuts here over the next 18 months.
Ira, you mentioned how the committee comes together. It just makes me think of Draghi back in the day. Draghi back in the day would bully the governing council into making the decisions that he wanted to make them. He would basically go out there and offer his opinion and back everyone else into a corner. They'd complain, we'd see the leaks in news outlet, including this one, repeatedly, but he'd get them to where he wanted them to be. Chairman Powell, how different a beast is he? Is he reflecting the consensus of this committee today? Is he speaking for himself? Whose voice is this?
Yeah, it's a good question. So, post-meeting press conferences, he's speaking for the whole committee. In a speech like this, he can stray from that a little bit, but I do think that he's going to be very mindful of not pre-committing and not putting words into, the committee's mouth. So I do think that he will be speaking a little bit more from the committee's perspective as opposed to his own. But at the same time, look, we had the minutes on Wednesday. I very much doubt that he's going to stray meaningfully meaningfully from what the tone of the minutes was. And the tone of the minutes, when you look at like our natural language processing sentiment indicator, which we run on the minutes and on Powell's speech and a few other items that the Fed puts out over the course of a month, showed that they're in cutting territory, that their sentiment is dovish, and that they want to be cutting at some point in the near future. Not necessarily aggressively, in fact, but that's a little bit different than what the market's pricing. But nonetheless, like the tone of the minutes in aggregate is definitely dovish.
Ira, you talk about volatility, and so I wanted to pick your brains a little bit on how do you see interest rate volatility into this easing cycle, assuming that the Fed does start it. They're talking about gradual, methodical. Does that mean interest rate vol's going to decline? Agency mortgages will do great? Or the fact, I mean, I feel like we've only been talking about the Fed, but there's payrolls, and then there's this election, which is a big one. Does that keep interest rate vol high into year end and beyond?
I think so, Priya. And as you know, we've been doing this a long time. So we understand that, liquidity isn't exactly what it used to be. And you have basically a lot of product to go through, relatively small pipes sometimes. And you don't have the balance sheet capacity in the dealer community that you used to vis-a-vis the size of the market. So I do think that volatility remained much higher than it had been, say in the 2007 timeframe. But nonetheless, typically speaking, when you wind up with interest rate cuts actually being realized and rates starting to go down, you do get sellers of volatility, right? Where people take advantage of the carry that some vol structures offer. So I do suspect that volatility will come down a little bit. Will it go all the way down to where it was, say, in 2014, 2015, when we probably wanted to, switch jobs because it was so boring about saying how many times can you, how many different ways can you say sell vol. But, it's not going to be that bad. But nonetheless, I do think that you will get a decline in volatility, but maybe not until they actually cut. And I think that that's an important point. And certainly data is going to continue to have realized volatility, keep maintaining that bid for implied vol.
That's fair. And I'm glad you brought a market structure because we're moving to more price-sensitive buyers. I think every auction is going to be scrutinized by the market. But if you think about the range, so maybe we have this higher daily realized vol, but in terms of the range, where would you see the 10-year? I know the election, so let's say pre-election. Between now and the election, where would you see the 10-year range?
Yeah, I don't think that 10s are going to be able to go back up above 4% at this point. We had been in the camp that we were going to see the 10-year yield somewhere around the mid 3% range by the end of this year, and I think that we're probably going to see that again, especially as the Fed gets into its easing cycle. Because we always focus, and this is one of the issues that we have with all of the information that we get. We're so focused on will the Fed hike in September, and will that be a 25 or 50? But Priya, as you know well, that's not what's important to the 10-year. It's where do we end up, say, a year and a half or 2 years from now? And that pricing continues to be relatively volatile. Moved 11 basis points yesterday, right? When you go out and you look at what happened to Z5 SOFR futures. So as we get further and further, I think it's going to be pretty clear that the Fed does want to cut and that they are going to cut down toward 3%, and maybe even a little bit lower over the next 18 months, and that's going to basically shift the whole curve. So 10s might rally to 3.5, but not much more than that. But the front end 2 years wind up rallying significantly further, just on the bond math of lower short-term interest rates mean that you get a bull steepening of the yield curve, and that's a hard trade to stay in because of the negative carry that's involved with that. But nonetheless, like if you're a cash investor, you probably want to be looking more at the short end of the curve to get your duration budget instead of the belly or the long end.
Ira, this was awesome. As always, sir, thank you. Ira Jersey there of Bloomberg Intelligence on this bond market. Priya, I want to pick up on your point on legacy, because I actually think it's really important. When it comes to these public officials in the business of risk management, and when it comes to legacy, I think they worry more about who they don't want to be than they do worry about who they want to be. And who they didn't want to be 2 years ago were the central bank chiefs that allowed inflation to get away from them. And I just wonder 2 years later whether the fear has shifted, whether now they worry about being the central bank chiefs that allowed unemployment to climb too much and caused a recession. Do you think the fear has changed in the last 2 years?
I think it's changed. It's changed in the last 6 months, really, because I think that immaculate disinflation, when inflation is that high, And so far from that 2%, you can't look at anything else. And so we became a single mandate central bank. But I think globally, as inflations come within the tolerance band, now they'll never say that their target is higher, but we're not that far from target. And the other side of the mandate has started to move. And I think, they've been saying we're coming better in balance. But I think, as you see, the unemployment rate never increases gradually. I know they're talking about gradual cuts, but you often have a non-linear increase in the unemployment rate. They have to be concerned. And it was slightly evident in the minutes that they're getting concerned more about downside risks on the labor market. I don't know if we hear that today or we hear that in the press conference in September.
Yeah.
But they have to be worried more about the employment side of the matter.
Certainly changed a lot in 2 years, that's for sure. It's changed a lot in 3 weeks. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers.
Hi, John. Let's get you some single stock movers, starting with Workday. Those shares are surging up more than 15% in the pre-market as the company signals a new focus on boosting profits. It expects it will reach an adjusted operating margin of 30% in the next 3 years. The company, which provides software around HR and other business operations, also announcing a $1 billion share buyback program. Shares of Ross Stores are also rising in the pre-market, up nearly 6%. The discount chain beating Wall Street expectations and raising its 2024 profit outlook as it saw more demand for its discounted apparel, while freight costs also eased. The company's results aligning with other retailers like Walmart and Target, which have shown consumers across the board are searching for bargains. And another stock moving higher is Cava. Those shares are rising more than 7% in the pre-market. The fast casual restaurant chain raising its full-year outlook after posting second quarter results that beat expectations. While many other restaurant companies have reported declines in visits as consumers pull back, Cava said sales at its restaurants grew more than 14%, nearly double what Wall Street expected. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the program, setting you up for the day ahead, the week ahead, and anticipating the big one. Fed Chair Jay Powell, live from a beautiful Jackson Hole, Wyoming, just around the corner.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
DOJ or other authorities
could face bigger challenges elected.
It was going to keep rating World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City, 38 minutes away from the opening bell. Equity futures here up by 0.6%. Your trading diary, the calendar for the week ahead, looks like this. In about 1 hour, we'll get remarks from Fed Chair Jay Powell from Jackson Hole at 10 a.m. Eastern Time. Then 1 hour later, Philadelphia Fed President Patrick Harker will speak with Bloomberg, followed by Chicago Fed President Austin Goolsbee at 2:15. Wednesday, we'll get results from NVIDIA. Thursday, another round of claims. And Friday, we'll get US PCE and unmatched consumer sentiment data. Turning to the main event today, Chair Powell speaking in just over 1 hour from now. Bloomberg's own Tom Keene, Bramo, joining us now from Jackson Hole, Wyoming. Guys, it looks beautiful as ever, Bramo. Is TK behaving? That's all we want to know on this side of the world.
Of course. Always. He is always behaving. Maybe. Are you
Maybe.
behaving?
I'm trying to be on good behavior. What we need to tell John, though, very importantly, as we go to this, is there were only 3 spiders in my cabin last night.
Oh,
so
boy.
It wasn't
Here, we're going to go there.
I looked under the bed for snake. A rattler wasn't there. What do we got?
Today is going to be really about defining gradual. Doesn't mean 50 basis points. Doesn't mean a 25 basis point rate cut. It's going to be setting up this market and this Federal Reserve for a rate cutting cycle. As you can see, it's a little bit smoky here. There are forest fires that are making it a little bit less clear, and maybe that's sort of a signal of the lack of clarity about where we are and whether we'll nail this soft landing.
The big thing to me is a calendar item here, and that we've got to get to September 6th and a jobs report. There's no way Chairman Powell's going to front run and be embarrassed by a September 6th report, as they were somewhat embarrassed or adjusted by an $800,000 jobs revision. So I look for a pretty much straight arrow speech. I don't look for a lot of surprises.
Well, we shall see. I will also wonder whether we see any dissent, because it's been a very long time, the second longest time in modern history, where we have not seen any dissent on this Federal Reserve. John, we'll be talking with a lot of Fed presidents. I'm very excited for the next couple of hours.
Lisa, choosing her company well. Remember, with the Bears, you just have to be faster than the next guy. That's what's important here. Bramo, thank you.
Thank you.
Alongside TK. It's beautiful, guys. Looking forward to the coverage. Thank you. Thank you very much. Priya, final word, please. What's the final word from you going into this address from the Federal Reserve Chair?
I'm going to be looking for a framework, context around those rate cuts. We know they're likely to start to cut rates. We know it's a cycle. I think the 25-50 is not that important. It may sound like sacrilege, but it's not. It's really, what's the total amount? How are they thinking about the rate cuts? Soft landing rate cuts are rare. So provide us a sense of, is this just normalization? We want to keep the same level of restrictiveness. We want to start to reduce restrictiveness. How does the Fed chair think about risk to the outlook? So I'm going to be watching for all that. You may have to read between the lines. I don't think it's going to be an 8-minute speech. He has to talk a lot. He might also talk about the framework review. There's going to be a framework review next year. Does he set it up? And this is the perfect place to start to talk about things like framework, context.
It's almost right. You don't want to get out in front of the committee. You don't want to get out in front of the payrolls report on September 6th either. There's a lot of work still to do before we get to September 18th, which is the next Federal Reserve decision. The 6th is the payrolls report. The 11th is CPI. Priya, this was great. It's good to see you. Thanks for the last 60 minutes. Appreciate it. Thank you very much. Coming up on Monday, here's the lineup for you. Some reaction to Chairman Powell and the address a little bit later. Here's the reaction on Monday. Peter Cheer of Academy Securities, former Fed Governor Betsy Duke will catch up with Liz Ann Sodders of Charles Schwab and Michael Collins of PGIM. From New York City, thank you very much for choosing Bloomberg TV. We're about 34 minutes away from the opening bell and about an hour and 5 minutes away from Chairman Powell in Jackson Hole. From New York, this was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Chair Powell can give a very clear signal that they'll cut in September.
What we're going to hear from him is that he is comfortable with the inflation backdrop. This is an environment where the Fed can start removing policy restrictiveness.
He's going to say that the Fed continues to face a number of challenges.
I think we'll get zero out of Jay Powell on Friday.
It's not about whether they go in September anymore. I mean, that debate is over.
This is Bloomberg Surveillance, live from Jackson Hole, with Tom Keene and Lisa Abramowitz.
Good morning, everyone. From Wyoming, from Jackson Hole, Wyoming, for our audience worldwide, Bloomberg Surveillance on television, on radio, and it is a perfect August Friday here in Jackson Hole with the backdrop of the political maelstrom, the Democratic convention. I know you stayed up, Lisa, and watched the entire, every minute of it as well, but now we turn to the Powell speech.
The key question here is how much can this Fed chair ratify what we're seeing in markets, which is the expectation for a rate cutting cycle after one of the longest periods without any move whatsoever after a rate hiking cycle by a Federal Reserve in modern history. A question here, can they stick the soft landing, and will he give any guidance whatsoever to a lot of people who think that it's not necessary?
I'm data dependent. I've had 14 cups of coffee this morning. They're data dependent. They're going to get out to the speech today and then on to the September 6th employment report, and maybe we stagger to the, I believe it's September 21 meeting.
September 18th, they're going to give a sense of whether they actually are going to cut rates or not. A key question that I have is how far have we already come? Take a look at, we are seeing a rally right now in markets after yesterday's sell-off, which is the biggest in 2 weeks. But what I find fascinating is just that we've seen the two-year yield move so much more than anything else. It is down more than a percentage point from the last time that we were here in Jackson Hole, August 26th. And you see that move. We're up more than 25% since that day on the S&P 500.
I'm going to get out front with an essay that I only discovered. Thank you, Peter Orszag at Lazard, for this. And that what we're battling with here in the years and years I've come here is we're still coming off the pandemic. Peter Orszag with Robin Brooks at Brookings writing a beautiful essay about, do we really know where we are off the pandemic? And that's an overlay not being discussed here, is where are we in that continuum?
And just sort of accentuating that overlay were the jobs revisions that we had just earlier this week, the idea of 818,000 jobs fewer that were added in the year ended in March versus the initially reported. We've got an incredible lineup today. We do have about a 0.6% gain in the S&P. I want to just get set up with Michael McHugh, who's sitting on set with us, not wearing his hat. He's been told not to by HR. I don't know why, because I think your 10-gallon hat looks absolutely fabulous when you head to the rodeo. Mike, what are you expecting today?
Smaller hat this year, maybe only 5-6 gallons. We're expecting kind of what you laid out with Tom, the idea that the Fed chairman is going to ratify the idea that rate cuts are coming without absolutely promising it or giving any kind of amount. And I think the markets have basically priced that in. The rate cuts are coming is what's got the 2-year yield lower. But going beyond that, the question then becomes, where do they stop? How far do they go, and how fast do they get there? And that's something else we probably won't hear today.
What's so important here, and Mike McKee's the expert on this, much less so me. The number one question I get here at Jackson Hole, particularly by media, why hasn't there been a recession? Mike McKee, why haven't we had the recession everyone except Raphael Bostic's predicted since time began?
We sent Lisa out shopping. No, we've had a number of reasons, two things in particular, well, three things in particular. One is the pandemic savings. The people got extra checks during the pandemic, and they had extra money to spend. We've also had some government fiscal spending with the IRA and the other acts that the Biden administration got passed. Most of that money hasn't gone out yet, but some has. And businesses have started committing based on the idea that it's going to come in. And then, of course, because unemployment was low, wages were rising. And I know, on the political side, wages have been rising faster than inflation, but nobody really gets that. But people have had enough money to spend.
Well, I will say that when I went shopping in the Atlanta airport because we were laid over there for about 3.5 hours. So that really is the key place that we want to focus right now. And we are so glad to have shopping expert in the Atlanta airport, Atlanta Fed President Raphael Bostic, who is with us here on site. Really appreciate you being with us, President Bostic. I want to start with a change in tone that we have heard from you over the past couple of weeks. It seemed like 3 months ago you were not that urgently feeling like we needed to see lower rates. You've kind of changed recently and really seen the need for it. What's caused that change?
Well, I think two things have really happened to lead for that change. First of all, good morning. It's good to see you all.
Good to see you.
It's really good to be here. The one change is that inflation has moved a lot faster than I had anticipated. Look, we've, for the last 2 years, have really been in a mission of getting inflation back to our 2% goal. We had seen a lot of progress. Early this year, it seemed like it may have been stalling out. I'm really gratified to see that it's continuing back on that pace, and that's a very good thing. And then the second part is the employment side. So we know that unemployment rates have gone from about 3.4% to 4.3%. That's a big change. Now, it's from super hot to solid, right? So I don't want to make it seem like labor markets are weak, but it really starts to tell me that things are much more imbalanced than they have been for quite some time, and that's really a sign that our policy has done its job, and now we need to start the path back to our more neutral stance.
More than anyone at the Fed, you've had a more holistic view with John Chauvin at Stanford, with all the academics you've done at Southern California about racism, about society and all. We're in the maelstrom of a political election. Greg Ip, writing in the Wall Street Journal in the last 24 hours, says the politicians are not practicing economics. How does the Fed get to the September meeting, get to the November meeting, and avoid the first Tuesday of November? How do you maintain Fed independence with this crazy economic dialogue we're hearing?
So I actually don't think it's that hard to remain independent. I think for us, the job is to keep our heads down, do our work, read the data, study it, get input from businesses and people all over this country to get a good handle about where the economy is, how it's moving, and how people feel it's going to move forward.
BP is working to roll out EV charging hubs in the UK, like opening one of the UK's largest public hubs in Birmingham.
Hold on.
And we're keeping oil and gas flowing, helping to meet today's energy needs. It's sand, not ore. That's how BP is backing Britain.
And their view of demand and business going forward.
Well, Mike, you should tell people more often. We spend a lot of time looking forward. That's actually a really important thing. We do surveys. Our bank has a lot of surveys that we do, asking what's your outlook for the next 6 months, for the next 12 months, and the like. We hear a couple things. So one, we hear that the demand for product is weakening, but it's still quite solid. We hear that businesses are not expecting to expand their workforces in a very significant way, but they're also not expecting to lay people off. That is not the mode. That they're really in a steady state where they can handle where things are, and their outlook for the next 6 to 12 months is by and large positive. Maybe a little lower in terms of revenues and profits from where we've been the last 2 or 3 years, but the last 2 or 3 years have been record-breaking pretty much in every sector, every industry. So it's a solid picture, and it's one of the reasons why I do think that we've had some space to be patient with our policy moves, and we'll just have to see whether their outlook plays out. I'm hopeful that it does.
Given the problems Lisa talked about earlier with the data and coming out of the pandemic and everything, how certain are you that your data is correct enough that you're not behind the curve?
Well, I mean, we try really hard to get our view based on the pulse that business leaders are showing at every moment. We talk to folks day to day, week to week, and we ask 2 questions all the time. One, what's your outlook for the next 6 months? And how has that changed relative to where you were 2 weeks ago or 3 weeks ago? We are trying really hard to notice those inflection points so that we can speak to that and we can bring that to our policy table and make sure that we're not behind the curve. But these are turbulent times. As you know, I mean, you all cover the economy. Things are happening in unexpected ways in many different venues and many different parts of the economy. And so there is a natural trend. There's always some uncertainty. And we've just got to...
See? Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Of the moment.
Well, markets are forward-looking. They're not in the moment. So everybody wants to know, where do you end up? Where do you think neutral is going to end up when you finish your cutting cycle?
So I'll say 2 things on this. One, in the SCPs and the dot plots, we have to put a long-run number. For me right now, that long-run number is 3%. I think it's a little higher than where it was at the depths of the pandemic. But where that is precisely is unclear. The second thing I would say, though, is I've really been focused much more on making sure that inflation gets to 2% than what a long-run number is. And now that we're close to moving on that way, that's a question that I will spend a lot more time with my team trying to figure out. In my building, we've started to have discussions / arguments about this, and in my building, I get views ranging from 2.5 to 4.25. Right, that's a large range, and we're going to have to narrow that down. And so I'm really looking forward to a robust discussion that will help me get a sense of where I think it is.
2 years ago, Jay Powell's speech was 8 minutes long. How long do you think this speech is going to be?
So, I don't get any insights on that. 8 is historically a record-breaking short. I'm not expecting we'll break records today, but we'll have to see what happens.
Raphael Bostic, president of the Atlanta Fed, thank you so much for being with us, and really interesting at a time, Tom, where we're seeing essentially this lack of clarity on what the next move is, even among people at the Fed, because ultimately the data could just shift things dramatically one way or another.
Yeah, I look at the Japanese report overnight. We saw some more inflation in Japan than maybe was expected. Can we just have a Jackson Hole victory lap for going from 9% to 3%? Was that transitory, Mike? Was it transitory, 9% to 3%?
What I've heard Fed officials say is it's transitory, but we never defined what transitory meant.
Well,
what's the time period we're talking about?
I don't expect him to unfurl the mission accomplished banner. I think that a lot of people are saying maybe we're getting to a place that's more comfortable. Don't expect anyone to really talk about comfort at the Fed.
I've always said they should adopt the motto of George Aiken, the Vermont senator during the Vietnam War, is how to get out of the war. Just declare victory and go home. Just the Fed should just say, we hit the soft landing, and you guys can stop worrying about it.
It's going to be really, really interesting. In this speech today, it is a carved-out sentence-by-sentence analysis. And they know that. I mean, and I would suggest it's been rewritten since that labor revision.
Well, we will see. Coming up next, we have Adam Posen of the Peterson Institute, who will be joining us here on set, wearing something more than just simply a T-shirt, like that one time when he came with short sleeves.
That's great.
And it was about 40 degrees outside. From beautiful Jackson Hole, Wyoming, this is Bloomberg.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
And stories they create.
Nobody covers technology like Bloomberg. Context changes everything.
There is this real momentum.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, And who do you need to work with? Upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do three things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Fed independence. You have a whole list of things that are going to potentially, I think, likely drive up inflation. And going back to the narrative point that Mohammed raised and you discussed, there's this entrenched narrative now that the Fed's going to be cutting through 2025 and 2026. And even if, as Tom says, Powell navigates that and just sort of focuses on, well, we'll probably do something the next 2 months. What I'm concerned about and wrote about in the Financial Times yesterday is, 6 months from now, 12 months from now, they're going to have to pivot.
Well, your FT article, your essay in the Financial Times is frankly blistering. In the middle of it, you're kind to Chairman Powell and say he's been out front on a balanced analysis of migration. Let's be clear, immigration and migration are not top of the tier, but right up there in this election as well. What is your study of what migration and immigration have done as Chairman Powell and the Fed have to make a decision?
Well, my colleagues at Peterson Institute, Michael Clemens, Warwick McKibben, and others, as well as others working in the field, have established, basically beyond a doubt, that migrant workers, whether documented or undocumented, are a benefit to the U.S. economy. You were saying when talking to Bostic and leading in, why did we have this soft landing? Why are we in triumph? A chunk of it was that we had actually a lot of immigration. And the key point is, it's not that they take jobs from Native people. That is a lie. They do jobs that Native people mostly don't want to do. Mm-hmm. They do food processing. They do fruit harvesting. Right. They do residential construction, low-skilled, dirty labor. They do cleaning jobs. And these are inputs to production. And the more of this you have, actually, the more Native jobs you have, and the better your fiscal situation.
I got bad news for you folks. My nerd book of the summer is from Adam Posen, Maurice Obstfeld, Doug Irwin, and all at the Peterson Institute. It's a beautiful 50-year look back. And you have a blistering comment in the beginning where you talk about in foreign exchange, our non-system. Let's bring the non-system over to Fed policy. Right. Do we have a Fed policy that's a non-system now because we're making it up as we go?
Well, as you indicated before we started talking, Tom, you were talking about the idea that, like every central bank, you just get through things. And so 32 years ago, Bernanke in Michigan wrote an article in which I thought was seminal, talking about the idea that central banks are firefighters. They deal with the problem that's in front of them, and then they move on to the next problem. What inflation targeting, which Bernanke, Michigan, Laubach, and I advocated, was trying to get a little more anchored in a more specific way than Mohammed was talking about. That you look at the 2-year ahead forecast, you look at where inflation is going, and that's your guide. And this is why I'm out there beating the drum, as it were, because I feel that it's fine when you're at inflation's way too high and you know which direction you're going for the next 2 years to say, okay, I'm data dependent. It's not fine when we're about to have a pivot point, largely due to the election, but it's still a reality towards a much more inflationary environment.
Peter Orszag and Robin Brooks are writing. They're at another institution in Washington. I can't remember the name of it right now.
Obscure.
But Orszag and Brooks are writing about we're underestimating how we're still with this pandemic. From where you sit at the Peterson Institute, or to use Orzag's phrase, are the glide paths of the pandemic still in place?
I love that essay from Peter and Robin, and Peter's actually on our board of directors, I'm proud to say. But I actually take it slightly more positively. So I'm in the midst of some work about the idea that actually the huge job dislocation that we saw during COVID, nobody anticipated it, but it ended up being productivity enhancing. What you see is a bunch of people moving jobs within the same industry to better employers, better benefits, better capital, sometimes moving up. And this has jumped up productivity growth and helps explain why we have the soft landing we have. Is that going to go on indefinitely? No, that's a one-time shift. But I think that we have seen more benefits, bizarrely, not unexpectedly, from COVID.
No Fed official has dissented at a meeting since June 2022. This matches the longest streak going back to 2003 to 2005. Is that a problem for you?
It's indicative of a problem, yeah. I mean, I think, Lisa, I retweeted, I think you put that stat out yesterday, and I retweeted it, because it's potentially a sign of groupthink. Now, again, when you're in a crisis, and this was true in 2008, 2009, and arguably it was justified in 2022, 2023, that you wanted to have unanimity. You're so far away from where you need to be, you don't want there to be any dissent. But now that we're coming to a choice point, it's a problem. And it is, Chair Powell apparently at the previous press conference said he'd be fine with some dissents, and I'm glad he said that. But it's, I think, time that they start expecting a dissent.
Adam Posen, always wonderful to hear you dissent and not think in a groupthink kind of way. Adam Posen of the Peterson Institute, thank you so much for being with us. If you were on the Federal Reserve Committee, you would be the dissenter, Tom. I think that's for sure.
Adam Posen, public service to the Bank of England, where Catherine Mann is right now. And I've stayed to say this, Pharaoh's been in those press conferences. They do it so much better than we do in terms of outlining dissent. In fact, Catherine Mann has been a leader on the more hawkish tone of the dissent at BOE. Adam Posen's agreeing with me. We got through this without talking Red Sox baseball, which is an outrage.
That was by design. I will say that this is also the longest period of time between when the Fed last hiked rates before they cut rates, going back to the 2006 time period. It just is an interesting moment because we're looking at a time when it was quite obvious what the Fed had to do. Now it's less so, and I think that
turning points at the choice point that Adam was talking about. That's where we are, and that's when they get paid. I mean, this is where it's real.
And right now, you're seeing people get paid a little bit in markets. You're seeing up about 0.6%, reversing some of yesterday's losses, the biggest down day in about 2 weeks. Coming up next, do not miss this. Former Cleveland Fed President Loretta Mester here on set. Mike McKee, I imagine, will also be donning his hat. Hopefully, I'm still lobbying for that, Mike. I want that on from Wyoming, not New York. This is Bloomberg Surveillance.
most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be, and it's a self-fulfilling prophecy. If you bought NVIDIA a year ago or 2 years ago, you're pretty excited about where it is today, and you think that it could go to the moon. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
To be a value investor is to pay less than the business is ultimately worth. And if the price 2 years from now should be considerably higher than it is today, the stock is likely undervalued.
About 25 seconds until the market open. We are in Wyoming for the Jackson Fed. Tom will be counting us down. Right now you are seeing a lift to the market ahead of time. About 0.6% gain on the S&P. Seeing the NASDAQ actually outperforming, trying to reverse some of the losses from yesterday. Yields a bit lower as well.
Can we go to a Greenspan moment where Alan Greenspan used to always say, would everybody pay attention to chapter 23 of any basic economic textbook, Begg, Mankiw, whatever. The stock market matters. The stock market's screaming something. I'm not sure what it is, but it's up, and away.
Well, it's screaming that maybe it's a reversal of yesterday's dashed hopes about a 50 basis point rate cut. You're seeing yields reverse once again, down about 2 basis points on the 10-year. The 2-year is really what I'm watching today. And frankly, over the past year, down more than 1 percentage point since the last time that we were gathered here at Jackson Hole, at a time when people are really expecting some sort of beginning of a rate cutting cycle. Unclear, though, just how deep that will be and whether gradual means 50 basis points at some point.
And the push, that's really well done about the last 12 months and about the dynamics we've seen. But the push here has been everybody looking for some form of GDP slowdown, NBER recession, not some other vanilla flavor of it. I don't know. It hasn't happened. Well, the heart of the matter is a recession hasn't happened.
Not only hasn't it happened, but the S&P 500 is up 25%, more than 25% since August 26, 2023, when we last heard from Jay Powell. The focus there very much on bringing down inflation. Now we're expecting to hear much more about employment concerns and maintaining a robust labor market, as we do see the unemployment rate tick up about 0.5% from 3.8% at the last time he spoke to the current place of 4.3%.
And the word that everybody uses is solid. And, you know, when you have Loretta Mester coming up, the answer solid doesn't cut it, because the mathematician's going, what in God's name is solid? But there we are. We have a solid economy.
Well,
I don't know what that means.
Well, we'll find out from Loretta Mester, who's sitting us. She is former Cleveland Fed President Loretta Mester. This is the first time that she's joining as a non-Fed member in 10 years at this Jackson Hole meeting. Loretta Mester, President Mester, I will still call you that. You've always been a thought leader. How much do you hear more dissent than usual among members at a time where we really are at a pivot?
I'm not hearing that much dissent, frankly. I think we're in a good place in terms of where the economy is. If you think about inflation, look how much it's come down. You know, we're in the 2.5% range, and the labor market is moderating. There's definite signs of that, but it's not weak. Right? It hasn't turned into a strong, weakness coming into it. So we're in a good spot. And now what the Fed needs to do is make sure that it can maintain the momentum of inflation going all the way back down to 2% while keeping the labor market healthy. And I think that's where the focus is going to be. If you remember at the start of the tightening cycle, we had to go very aggressively because policy wasn't well calibrated to where the economy is and where it was going, or was and where it was going. And now we want to make sure that, the Fed wants to make sure that policy stays well calibrated to the economy. So the discussion now, I think, is about, we have a dual mandate. We have to focus on both parts of that. we have to be forward-looking. You know, it's where the economy is going, not necessarily where it is here today, but where it's going. And that's why I think now it's actually appropriate to really be thinking about, okay, it's time now to enter this new phase where we can start normalizing the policy rate.
Wall Street and the financial media want specificity. They want certitude. They want single-point statements about exactly where we are. The reality is, just to look at productivity is a capital analysis, a labor analysis, and an all-in analysis. Call it total factor productivity. The noise in there, to me, with the overlay of technology, is highly uncertain. Do you have any handle of the overlay of productivity and technology's effect on the Cleveland and American economy?
Well, I mean, we've seen over history, right, that technology can be very additive to productivity growth, right? I mean, that's kind of the engine of an economy that's increasing and having, you know, potential growth rise. But in any point in time, it's very hard to measure productivity growth. Even if we didn't have this big technological innovation of AI, it's very difficult to measure it. So you have to take into account that there's uncertainty around productivity growth. I mean, some estimates say that we're still in a low productivity regime. Other estimates are saying, you know, let's look forward, maybe we're going to be in a higher. But for the Fed right now, right, that's not sort of the focus. The focus is, you know, are we calibrated well? Is policy calibrated well to the economy?
Mike, you've been great on this. She just said they're not focused on productivity. We have to be, because business leaders every day are focused on those outcomes in their investment.
Well, they've sort of been forced to by inflation and a lack of workers, and they've been forced to put investment into productivity. We'll see if it starts to pay off. But Loretta's right. At the moment, you know, you're not seeing it, but that's not the key for them. But I do want to know how you respond to the criticism that the Fed has not communicated well what it's thinking and what it's planning, or if not planning, you know, what are the potential outcomes? Because we've seen some very wild swings in the markets as data comes around. Have you said data dependent too much?
I think there's a misunderstanding of what data dependent means, and that means that I think Chair Powell today will be explaining where he sees policy going, not necessarily at the next meeting, whether 50-25, which in some sense is really not the big issue. I know for financial markets it is, but not in terms of monetary policy. It's really, what's the path forward? Are we beginning now to bring policy down? And the pace, of course, and the magnitude eventually of how far interest rates go down, that's going to depend on how the economy evolves, right? But we're going to enter this new phase, I think, and appropriately so. In July, I probably wouldn't have supported actually moving the rate down in July, and of course the committee didn't, but I could have made a case for it. And that's a change, right? The economy has changed enough. Inflation has come down quite a bit. It's on a path, I think, where we can be pretty confident it'll get back to 2%. And now we really have to balance both sides of the mandate. So it's basically keep the momentum going on inflation, at the same time making sure that labor markets remain healthy.
What do you think it would take for the committee to decide you needed to do more than the standard 25 basis point cut?
So I think it would have to be that, you know, somehow they thought they were a little behind and they needed to catch up. And frankly, I don't see that in the data. I think they're actually in a very good place. Now, if it turns out that, you know, the forecasts are saying, wow, you know, we may be seeing the moderation in labor markets being more than moderation, and we actually see a weakening, they may have to adjust that and then do more. But I think there's sort of a record. If you think about when we started to raise rates, right, we started at a 25, then a 50, then we did our 75s. And that's sort of the preferred path, because that means, you know, you're not doing too much too ahead of time. And the other thing I think I would be worried about is if you do a 50 to start with, the markets then, you know, build in even more. And I think that's a calibration that you have to think about when you're doing this. So I think being steady, right, thinking about what the right pace is, geared to how the economy is working and evolving, is the right way to go.
You said that you expect Jay Powell to come out and give a sense of where we're going. And I think that's actually the frustration for a lot of people in markets. We don't know where we're going. We don't have a sense of what the neutral rate is. Right now, the market has about 200 basis points of rate cuts priced in by the end of next year. Is that appropriate? What is neutral?
Well, remember what the markets are doing is, and appropriately so, looking at different scenarios, right? They're waiting, and then when you get those kind of things out of the financial markets about how many rate cuts, it's balancing different scenarios. When the Fed's talking about, where they're seeing is, they're talking about, here's what we think if the economy evolves as we expect would be appropriate policy path. But they also have to think through other alternative scenarios too. So it's kind of a different answer or different answer to a question. And that's, I think, the frustration is that the Fed is trying to answer a different question, is here's where we see policy going. But of course, they don't want to commit themselves to something because the economy could evolve differently. And that's been hard to communicate.
You founded an inflation lab at the Cleveland Fed. What do you think inflation dynamics are now? Is this a completely different kind of situation post-pandemic than models coming out of other recessions have worked with?
Well, I think one thing that we saw during the pandemic and the aftermath was that the supply side, right, had a lot to do with inflation dynamics. But the key thing to remember is that those supply shocks would not have necessarily resulted in higher inflation if we hadn't had a very strong demand side of the economy. So it's this balance between supply and demand. Typically, right, in the past, right, it was all about demand. Supply, you could sort of say, was sort of stable, and it was all about how demand was moving around. In this event, right, it was both supply and demand, and that made it more challenging. And so in that sense, I think there's a renewed understanding that dynamics on inflation, it's both sides, it's supply and demand, and understanding both, I think, is going to be a focus going forward.
Well, as the Fed goes into its review process for its monetary policy framework, does what happened change the way you think the committee should look at policy? In other words, maybe you want to be a little bit more preemptive than you were?
So I know a lot of people characterize the Fed in the framework that came out in 2020 as walking away from being preemptive. But if you actually look at the language in there, still says preemptive. I agree with you that it sounded like we were just being data dependent in the moment, but we always were focused on where is the economy going. So it's data coming in. Assess that data relative to your outlook. If it's materially different than you expect, you might have to change your outlook, and therefore you might have to change your expected policy path. So I think we've always been forward-looking, and I expect the Fed to remain forward-looking. They may change the language in the statement so that that's a little bit more transparent, if you will, so that people actually understand that the policy has to look forward.
I would never ask you this question if you're on the watch, but now that you're gainfully retired and in the real world, I'm going to ask you this question. Cleveland has reasonable real estate, but Shaker Heights has a boom real estate economy. And part of that asset success of Shaker Heights and the Shaker Heights of America is the gains the haves are getting from this financial system. How does the Fed distribute the benefit more across America rather than this illusion that only the have-nots that own it, the haves that own NVIDIA are making way?
Yeah, I mean, the Fed always focuses on the macroeconomy, right? It doesn't have tools that can really do much about redistributing or fairness or making sure that everyone gains. But what we can do at the Fed, and what the new committee will be doing at the Fed, is making sure that we maintain healthy labor markets, which again helps distribute, and brings inflation and the inflation rate down. And getting back to price stability is also very key to having a strong economy so that everyone can prosper from the economy. the Fed really can't do the other part of what you're talking about, and that's what the federal government policies are about and fiscal policy is about.
We thought that you were going to retire and build homes as you try to offset some of the supply issues. Loretta, there is this question. Mike was talking about how you're the queen of inflation studies and how the Cleveland Fed really does have an incredible metric for that. Do you have a sense of how much more inflationary this post-pandemic economy is? And that really speaks to what is the new neutral?
Well, there are certain factors that really affect inflation, right? But the basics are similar to what we saw before, right? Inflation expectations are still an important driver of inflation. Making sure they remain stable is helping to keep inflation moving down, which is important. Supply side conditions matter, and labor market tightness matters. We're going to hear a paper at Jackson Hole that's really addressing that, how much tightness in the labor market affects what you might see when demand gets out of whack with supply. So again, right, it's the same basic factors, but of course the supply side during the pandemic changed quite a bit, and those factors are going to become, I think, more significant going forward than perhaps they were in the past.
Are you having more fun now that you're not on the committee?
I'm having fun.
Well, hopefully you can go hiking or enjoy the beautiful Wyoming. Loretta Mester, formerly of the Cleveland Federal Reserve, just going back to the end of June when you stepped down, and she is here for the first time in 10 years, not as a member of the committee, but as a civilian who is planning to do lots of things in her free time. But Tom, to me, this is really the key question that you bring up. How much, and this goes to the core of what the theme of the Fed meeting is, how much is under the Fed's control and how much isn't?
Well, there's a whole theory on this, and I thought that Dr. Mester answered it perfectly, in that the Fed has a mandate, a mission, and then you go over to fiscal. But this goes into what the great unspoken is at this meeting. I believe there's a calendar date, November 5th, and no one here is talking about November 5th because that gets to the fiscal debate.
They don't really want to weigh in on something that they don't know.
Anne-Marie Horton is not here. Let's make it clear.
She is definitely in Chicago after yesterday's speech. Coming up next, we've got ECB Governing Council member Mario Centino. He will be joining as we talk about the influence of Fed policy on the rest of the world. Right now in beautiful Jackson Hole, we are seeing markets indicate a little bit higher after yesterday's sell-off. This is Bloomberg Surveillance.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
There is this whole concept that we are way too restrictive
But that is only if you have R* or where the Fed is growing at a much lower level, maybe I say 2.5 or 2.8 as the long run dot says. Then it's true that we are restrictive. Then you need to see the Fed cutting rates quickly. What is the incoming data telling us? The Fed last hiked rates in July of 2023, and still now 12, 13 months later, we're still waiting for the data to slow down. Godot didn't arrive here over the last really 18, 24 months. Why should Godot arrive in August of 2024?
Waiting for Godot here in Jackson Hole. That was Torsten Slok, Apollo chief economist, talking to us about the Godot of a slowdown that never came, or at least not yet. No one's really talking about mission accomplished here. There is a shifting focus, though, to the employment side of the mandate. Tom Keene here, and honestly, to me, I think that's the most interesting thing. People are very much looking at weakness rather than really talking about inflation and the difficulty of getting it to 2%.
We're going to advance this in a moment with the view from across the Atlantic. But you had it dead on earlier, Lisa, this nuance of gradual and measured or sudden glide paths of how we come out of crisis, or as Adam Posen said, at a choice point like we're at right now. What are those decisions, and do you stay gradual or do you stay measured? That's unspoken in America, where in Europe it's much more overt.
Yeah, it's much more overt at a time where maybe the mandate is a little bit more challenging in terms of both the weakness and the inflation. Joining us now to talk about it is Bank of Portugal Governor and ECB Governing Council member Mario Centeno, who can tell us all about all of the beautiful places in Portugal that we all want to go. Thank you so much for being with us here today. Let's go there. How different is the picture in the U.S. versus Europe when it comes to the dual mandates of inflation and employment?
Good morning, and thank you for having me. It's not as much of the mandate. We always have to look at the data as a whole. We know that prices are the result of what the economy is doing at any moment in time. We have an economy that doesn't grow in Europe, contrary to the U.S. In the last 2 years, the European economy grew by less than 1%, while the U.S. economy expanded close to 5%. This is a completely different picture. And inflation in Europe came down very fast, actually faster than it went up. We are approaching 2% in our forecast. Since we first forecasted 2025, the forecast for inflation was at 2%. Anchoring expectations in Europe has been part of what we see in the data since the beginning of this inflationary period. Today, we look at the five-year inflation, and it's 2.1%. That includes a risk premium, so that means that inflation expectations are actually below 2%, most likely. So this is the differences. These are most of the differences that we'll see in a nutshell between the U.S.
You were weaned at Harvard with Lawrence Katz, so you've got a real understanding of American central bank history. And of course, so much of that is Greenspan and measured. There's a raging debate in Europe right now about the path you're going to take, looking at real rates, looking at the nominal rate, and how to be gradual, how to be measured in a newer bank, the ECB. How do you perceive the rate trajectory being given disinflation as you try to move to a European soft landing?
Well, the case is that Europe landing was to a plateau. We are not growing, so the economy is not growing. Let me take that again. We need to continue in Europe working towards better policy coordination, fiscal and monetary. That has been a huge problem in Europe in the last 2 decades. 2020 was a great example of both policies moving together. We need to continue in that vein. And that actually tells a little bit the difference between the US and Europe as well. Mm-hmm. I am very happy that fiscal policy in Europe in the last couple of years helped in the disinflationary process, because it was much more contained than the one in the US. And we have to continue working together so that this coordination makes everyone's work easier.
I interviewed Christine Lagarde here exactly 12 months ago, right on this spot, and she wanted a new ECB monetary policy and process of monetary policy. What do you see as the ECB policy forward after the Olympics, after the huge 24-month success? What's the policy forward given a slowing European economy?
Of course, the most likely move in terms of monetary policy is to continue cutting rates, so the easing process.
Would you like to give us a date on that so we can make some news today? Our colleagues at the ECB are like...
September, it's easy. October is going to be a funny meeting. Okay. It all depends on the new data. It always dependent on data, but it's not on data points. It's on data trajectories. We don't look at data points. We look at data trends. So that's the important thing also to mention.
You were talking about the difference between Europe and the U.S. and saying essentially the trend in inflation is actually lower in Europe than the U.S. So why does it make sense for the U.S. to be forecast to cut more aggressively than Europe?
Well, let's see what happens. We still don't know what will be the trajectory for the U.S. I think the decoupling story is not an important one. We have to look to the numbers in our economy. We are a 350 million citizens area. We need to bring inflation down with the lowest possible sacrifice. And there has been quite a bit of a sacrifice in Europe to bring inflation down. It's even in this soft landing story, we don't grow. Investment is very low in Europe, even in a situation in which we have next generation EU investments popping up, new investments in Europe. So we really need to take this seriously. The gamble for me right now is whether or not the labor market tensions will come up, because this will be the main risk that can turn the game a bit.
Will the ECB ever go back to negative rate policies?
Well, we don't want to. We are working very, very hard to avoid that. But we must remember ourselves that before this inflationary period, for close to 1 decade, average inflation in Europe was 0.9. So the fundamentals of the European economy are not compatible with inflation above 2%. We need to be very careful about it. And again, the gamble is, will employment hold in the context of a stagnant economy or not? Because if it doesn't, then everything will speed up.
I have 30 seconds. The American economist Madonna said a couple years ago, Lisbon is the place to be. What is the magic about a Lisbon where Madonna says everybody in America has to move there?
You know,
what's a pixie dust?
It's the people, the light, and the food.
Okay, can I just say, he's trying to basically see if he can get property there, and he knows that Americans are banned, so he's trying to lobby it.
We're lobbying here.
Yeah.
Make a
You'll be
governor.
welcome.
Okay, thank you. There you go.
Really?
Get that on tape.
Oh,
Thank you.
Thank you, Portugal Governor and ECB Governing Council member Mario Centeno. Thank you so much for being with us. We are just about less than 5 minutes away from Jerome Powell. We are going to bring that to you live when he does come out and give a speech. Really curious to see, Tom, how much he gives the market what it's looking for in terms of rate-cutting path versus doesn't try to rock the boat, because why?
Yeah, we'll have to see. I think Mike McKee's on top of it, and he'll have a lot of in-depth coverage of that right at that moment.
We'll be talking to former St. Louis Fed President Jim Bullard, Tracy Alloway, and Joe Weisenthal of Odd Lots. Also, don't miss this, former Kansas City Fed President Thomas Honig. From a beautiful Jackson Hole, just moments until we hear from Jerome Powell. This is Bloomberg Surveillance.
What are your thoughts on fast fashion? It's been transformative. It gives the masses access to fashion, but there's a cost to it, downside to it.
My first notice is too much waste. I think this is also how I grow up, making your own clothes and making something that's well special and well unique. It's like timeless. And now you see that everybody is looking the same, wear sweatshirts and wear T-shirts. And for me, it's just like when they wear something that's special, they feel empowered.
Is there a need for fashion to be more mindful of the impact it's having socially, environmentally?
Definitely.
Is it happening enough?
I think it's happening. It's gradually happening. All the designers are doing, everybody is thinking about this subject at this moment, thinking how to be more sustainable, how to be more environmental friendly.
Do you think the fashion industry is doing enough, to ensure that it is sustainable? There's so many targets out there. Are they even realistic in wanting to achieve them?
I think some of them are just like they're using sustainable ideas as a marketing concept only. They're actually not really doing it. I think as a designer, it's really important to really make it happen. Every collection, I think about how to do it and how to tell the customers. I think that is our responsibility to educate our customers.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's handpicked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive replays all weekend, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. This is Bloomberg Surveillance, live from Jackson Hole, with Tom Keene and Lisa Abramowitz.
Good morning from Jackson Hole, where all of economics, finance, and investment await the Powell speech. Lisa, this is the moment hugely anticipated, particularly in the last 2 weeks.
Yeah, we are waiting for his speech. Last year, he used the word labor market 13 times, used the word inflation more than 40 times, I should say, giving you a sense of where the focus was last year. This year, expected to be reversed.
And very quickly here, I would look for a longer, more developed speech than what we saw 2 years ago, I believe it was, the 9-minute wonder. We're not going to see that today.
Yeah, that was record-breaking in a lot of ways. Joining us right now, Bloomberg's Michael McKee ahead of this speech. We are seeing an introduction to Jerome Powell, who is in that room right ahead of us. What are we expecting? What are we hearing right now?
Well, we are waiting for him to come up, and in about 2 seconds, we can tell you that there is going to be market-moving news. Jay Powell is going to announce that the Fed is going to be cutting interest rates. The takeaway today, the balance of risks has changed, and it has become more important for inflation.
Yeah, Mike, let's head over right now. Jerome Powell, the head of the Federal Reserve. Let's take a listen.
4.5 years after COVID-19's arrival, the worst of the pandemic-related economic distortions are fading. Inflation has declined significantly. The labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic. Supply constraints have normalized, and the balance of risks to our two mandates has changed. Our objective has been to restore price stability while maintaining a strong labor market, avoiding the sharp increases in unemployment that characterized earlier disinflationary episodes when inflation expectations were less well anchored. While the task is not complete, we have made a good deal of progress toward that outcome. Today, I will begin by addressing the current economic situation and the path ahead for monetary policy. I will then turn to a discussion of economic events since the pandemic arrived, exploring why inflation rose to levels not seen in a generation and why it has fallen so much while unemployment has remained low. So let's begin with the current situation and the near-term outlook for policy. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. The FOMC's primary focus has been on bringing down inflation, and appropriately so. Prior to this episode, most Americans alive today had not experienced the pain of high inflation for a sustained period. Inflation brought substantial hardship, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. High inflation triggered stress and a sense of unfairness that linger today. Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. Turning to employment, in the years just prior to the pandemic, we saw the significant benefits to society that can come from a long period of strong labor market conditions. Low unemployment, high participation, historically low racial employment gaps, and with inflation low and stable, healthy real wage gains that were increasingly concentrated among those with lower incomes. Today, the labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%. Still low by historical standards, but almost a full percentage point above its level in early 2023. Most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen, and the ratio of vacancies to unemployment has returned to its pre-pandemic range. The hiring and quits rates are now below the levels that prevailed in 2018 and 19. Nominal wage gains have moderated, and all told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions. So let's now turn to the questions of why inflation rose and why it has fallen so significantly even as unemployment has remained low. There's a growing body of research on these questions, including Gowdy Eggerson's work, which we'll shortly discuss, and this is a good time for this discussion. It is, of course, too soon to make definitive assessments. This period will be analyzed and debated long after we are all gone. The arrival of the COVID-19 pandemic led quickly to shutdowns in economies around the world. It was a time of radical uncertainty and severe downside risks. As so often happens in times of crisis, Americans adapted and innovated. Governments responded with extraordinary force, especially in the United States. Congress unanimously passed the CARES Act. At the Fed, we used our powers to an unprecedented extent to stabilize the financial system and help stave off an economic depression. After a historically deep but brief recession in mid-2020, the economy began to grow again. And as the risks of a severe extended downturn receded, and as the economy reopened, we faced the risk of replaying the painfully slow recovery that followed the global financial crisis. Congress delivered substantial additional fiscal support in late 2020 and again in early 2021. Spending recovered strongly in the first half of 2021, and the ongoing pandemic shaped the pattern of the recovery. Lingering concerns over COVID weighed on spending on in-person services, but pent-up demand, stimulative policies, pandemic changes in work and leisure practices, and the additional savings associated with constrained services spending all contributed to a historic surge in consumer spending on goods. The pandemic also wreaked havoc on supply conditions. 8 million people left the workforce at its onset, and the size of the labor force was still 4 million below its pre-pandemic level in early 2021. The labor force would not return to its pre-pandemic trend until mid-2023. Supply chains were snarled by a combination of lost workers, disrupted international trade linkages, and tectonic shifts in the composition and level of demand. Clearly, this was nothing like the slow recovery after the global financial crisis. Enter inflation. After running below target through 2020, inflation spiked in March and April 2021. The initial burst of inflation was concentrated rather than broad-based, with extremely large price increases for goods in short supply, such as motor vehicles. My colleagues and I judged at the outset that these pandemic-related factors would not be persistent, and thus that the sudden rise in inflation was likely to pass through fairly quickly without the need for a monetary policy response. In short, that the inflation would be transitory. Standard thinking has long been that as long as inflation expectations remain well anchored, it can be appropriate for central banks to look through a temporary rise in inflation. The good ship transitory was a crowded one, with most mainstream analysts and advanced economy central bankers on board. I think I see some former shipmates out there today. The common expectation was that supply conditions would improve reasonably quickly, that the rapid recovery in demand would run its course, and that demand would rotate back from goods to services, bringing inflation down. For a time, the data were consistent with the transitory hypothesis. Monthly readings for core inflation declined every month from April through September 2021, although progress came slower than expected. The case began to weaken around mid-year, as was reflected in our communications. And beginning in October, the data turned hard against the transitory hypothesis. Inflation rose and broadened out from goods to services, and it became clear that high inflation was not transitory and that it would require a strong response if inflation expectations were to remain well anchored. We recognized that and pivoted beginning in November. Financial conditions began to tighten, and after phasing out our asset purchases, we lifted off in March of 2022. By early 2022, headline inflation exceeded 6% and core was above 5%. New supply shocks appeared. Russia's invasion of Ukraine led to a sharp increase in energy and commodity prices. The improvements in supply conditions and the rotation in demand from goods to services were taking much longer than expected, in part due to further COVID waves in the United States. And COVID continued to disrupt production globally, including through new and extended lockdowns in China. High rates of inflation were a global phenomenon, reflecting common experiences: rapid increases in the demand for goods, strained supply chains, tight labor markets, and sharp hikes in commodity prices. The global nature of inflation was unlike any period since the 1970s. Back then, high inflation became entrenched, an outcome we were utterly committed to avoiding. By mid-2022, the labor market was extremely tight, with employment increasing by 6.5 million jobs from the middle of 2021. This increase in labor demand was met in part by workers rejoining the labor force as health concerns began to fade, but labor supply remained constrained, and in the summer of 2022, labor force participation remained well below pre-pandemic levels. There were nearly twice as many job openings as unemployed persons from March 2022 through the end of the year, signaling a severe labor shortage. and inflation peaked at 7.1% in June 2022. At this podium 2 years ago, I discussed the possibility that addressing inflation could bring some pain in the form of higher unemployment and slower growth. Some argued that getting inflation under control would require a recession and a lengthy period of high unemployment. And I expressed our unconditional commitment to fully restoring price stability and to keeping at it until the job is done. The FOMC did not flinch from carrying out our responsibilities, and our actions forcefully demonstrated our commitment to restoring price stability. We raised our policy rate by 425 basis points, our policy rate at its current restrictive level since July 2023. The summer of 2022 proved to be the peak of inflation. The 4.5 percentage point decline in inflation from its peak 2 years ago has occurred in a context of low unemployment, a welcome and historically unusual result. So, how did inflation fall without a sharp rise in unemployment above its estimated natural rate? Pandemic-related distortions to supply and demand, as well as severe shocks to energy and commodity markets, were important drivers of high inflation, and their reversal has been a key part of the story of its decline. The unwinding of these factors took much longer than expected, but ultimately played a large role in the subsequent disinflation. Our restrictive monetary policy contributed to a moderation in aggregate demand, which combined with improvements in aggregate supply to reduce inflationary pressures, while allowing growth to continue at a healthy pace. As labor demand also moderated, the historically high level of vacancies relative to unemployment has normalized primarily through a decline in vacancies, without sizable and disruptive layoffs, bringing the labor market to a state where it is no longer a source of inflationary pressures. A word on the critical importance of inflation expectations. Standard economic models have long reflected the view that inflation will return to its objective when product and labor markets are balanced without the need for economic slack, so long as inflation expectations are anchored at our objective. That's what the model said. But the stability of longer-run inflation expectations since the 2000s had not been tested by a persistent burst of high inflation. It was far from assured that the inflation anchor would hold. Concerns over de-anchoring contributed to the view that disinflation would require slack in the economy and specifically in the labor market. An important takeaway from recent experience is that anchored inflation expectations, reinforced by vigorous central bank actions, can facilitate disinflation without the need for slack. This narrative attributes much of the increase in inflation to an extraordinary collision between overheated and temporarily distorted demand and constrained supply. While researchers differ in their approaches and to some extent in their conclusions, a consensus seems to be emerging, which I see as attributing most of the rise in inflation to this collision. All told, the healing from pandemic distortions, our efforts to moderate aggregate demand, and the anchoring of expectations have worked together to put inflation on what increasingly appears to be a sustainable path to our 2% objective. Disinflation while preserving labor market strength is only possible with anchored inflation expectations, which reflect the public's confidence that the central bank will bring about 2% inflation over time. That confidence has been built over decades and reinforced by our actions. That is my assessment of events. Your mileage may differ. So let me wrap up by emphasizing that the pandemic economy has proved to be unlike any other, and that there remains much to be learned from this extraordinary period. Our statement on longer-run goals and monetary policy strategy emphasizes our commitment to reviewing our principles and making appropriate adjustments through a thorough public review every 5 years. As we begin this process later this year, we will be open to criticism and new ideas while preserving the strengths of our framework. The limits of our knowledge, so clearly evident during the pandemic, demand humility and a questioning spirit focused on learning lessons from the past and applying them flexibly to our current challenges. Thank you.
That was Fed Chair Jay Fed Chair Jay Powell wrapping up his annual remarks in Jackson Hole. We just heard a couple of really key metrics, and I want to go through them. That the time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data. We do not seek or welcome further cooling in labor market conditions. Tom Keene, to me, this was very much heralding the beginning of a real rate-cutting cycle, and not declaring victory, but seeing the emphasis very much squarely on the labor market.
Yeah, what I got right was that I thought every sentence would be crafted, and that's what I heard. I loved the last paragraph of the speech where he talked about the humility required forward and the limits of our knowledge. And a lot of what we're talking about here at Jackson Hole, and what they're talking about just over the behind the cameras, folks, is the limits of our knowledge, the humility of, okay, we got through a pandemic, now what?
Well, right now, what in markets is this is a Federal Reserve that is embracing market pricing, and markets are rejoicing. You could see stocks surging. You could see yields lower across the board,
and
down about 7 basis points.
Kept driving lower,
yeah. Which is actually a bigger than average move following a Jackson Hole speech. You see a lot of dollar weakness out there. You see the euro touching up on its strongest point, going back more than a year to July 2023. So you see this really sort of confirming the bias that we already saw in markets.
It was great. McKee came out of the embargo. We were talking, and halfway through the speech, he's day trading with Robinhood, trying to get out in front, trying to get out for the move. Is this a seismic change? Is there more going on here than I perceive?
First of all, let me say I did not trade with Robinhood, if anybody is listening. This is not a seismic change. This is just confirmation that the change is finally here. The Fed has been teasing it for quite some time. They've been looking at the data, waiting. Inflation's come down. They keep saying we just need a little more effort, a little more proof. And now Powell is saying we've got that. His confidence is high. And the takeaway is that the balance of risks for the Fed has changed. They have now gone from worrying about inflation to balance between inflation and the labor market. And now it's tipped a little bit into the labor market worries. As you pointed out, Lisa, he said that we do not welcome any further deterioration in the labor market. So they're ready to cut rates, did not go in the direction of by how much, but didn't suggest there would be a big cut, but confirming what the markets were believing, that in September we're going to get a rate cut.
And if you end up looking at what the Fed funds futures are saying, it's basically where they were before, between 25 and 50 basis points of a rate cut in September. I know, Tom, you're saying, what does it matter? But at a certain point, what this does mean is this is a Jay Powell that is very much on the same page with markets. Key to me was also this discussion around how much was due to Fed policy. Is there a sense that this is something that needs to be adjusted in a real way in terms of dropping rates with some acceleration through the end of the year?
Well, I think basically he's defending the Fed because there's been a lot of criticism, and they're going to go into this review, and people are going to be saying that the Fed should change the way it does things. And I think he's trying to stake out the position that, well, we were wrong, but so was everybody else, because this was a highly unusual situation, and that's why we got it wrong. And so it's a little bit interesting historical, I don't know if you would call it revisionism or just laying down a marker for the future historians of the Fed.
Well, Neil Dutta of Renaissance Macro, who has been a critic of the Fed, saying, please, just let's go already, says this was a good speech. So confirming what he was hoping from the Federal Reserve. Joining us now is someone who has been in that room, who has seen the decision-making and the speech crafting, former St. Louis Fed President Jim Bullard, joining us now. Jim, I would love your take on the speech. What did you think of it?
I thought this was a good speech. I thought it was not quite a victory lap, but certainly emphasizing that this policy since 2022 has been extremely effective in bringing inflation down substantially, putting us on a path to 2% inflation without substantial weakening in the labor market. The labor market was super hot. It has cooled, but it's only cooled to a sort of normal labor market, and so that's why everyone's talking about the soft landing. So I think to the extent there are critics out there, which is great, they have to contend with the fact that this policy worked very, very well over the last 2 years.
Jim Bullard, to your acclaimed speech years ago on regimes of a Fed staggering from regime to regime or planning from regime to regime, does this speech signal a new post-pandemic regime?
You know, this is going to be studied for years. This episode about disinflation without recession will be studied for many years, and exactly how it works is a good question. But Chair Powell said in the speech, I think, basically lined out the argument: if you can keep inflation expectations on target, and even when the world seems to be exploding with inflation, then you can get the disinflation to occur relatively rapidly and relatively painlessly. So I think that's a new mode for many people in thinking about how monetary policy works.
I've been asking this question, Jim Bullard, of many, and with great respect to your public service out of St. Louis, where is the unemployment rate that begins to hurt? For Jim Bullard, I think a lot of America wants to know, what's the statistic in unemployment rate where it says some pain? Is it 5%? Is it 4.x%? Where's that number for Jim Bullard?
You know, estimates of the natural rate for most people are in the mid 4% range somewhere. And so I think it's true that unemployment has come up, but it's come up from this, a three handle that it was at for several years. I think what you should think about is that the three handle is the thing that's unusual for the U.S. economy. Four handle would be a very normal market turn. And now we're at that level. Now, if it goes up from here, if it goes up substantially from here, that's going to be a substantial weakening. And that's why I think Chair Powell didn't want to get anything further to happen in the labor market. I think he said further cooling is unwelcome. Yeah.
I sat Jim Bullard here easily a decade ago with Alan Meltzer of Carnegie Mellon, and he lectured me on the silliness of a 50 basis point move. If we discuss a 50 basis point move, are we defeating all the history of measured and all the value of a gradual approach?
Yeah, I just think right now they just probably don't need to go 50 basis points. I think that would trigger expectations about a really rapid pace of rate decline. They probably don't need to do that. They would like to asymptote, have the inflation come asymptote down to 2%. Also, basically with this speech and certainly with the July meeting as well, they've been heavily signaling that they're going to make this move in September and subsequent moves. So that's already been priced in the markets. So they'll just be confirming at the September meeting what's pretty much already happened as far as market pricing.
Jim Bullard, the former St. Louis Fed president, thank you so much for being with us following that speech from Fed Chair Jay Powell at a time where markets are screaming higher. You could see that really advancing, in particular with the Russell 2000 up more than 2% on the heels of confirmation of the rate-cutting cycle
Crisis
beginning.
over.
Well, is it crisis over, or is this a new emphasis? How far will they go? A lot of questions around that, and we will continue to, of course, play that parlor game simply because the data dependency lives on, and that's what will determine the pace of the cuts.
Here we are with an event, and then the next event, I believe, is September 6th, which is not back to school. It's a jobs report. And, after the shock of 114, and, of course, the revisions off that, the revision here, I guess we knew it would be important, but maybe off the speech and the market move, it's ever more important.
Yeah, you're seeing the market move across the board. Through bonds, you see yields lower across the curve. Two-year yields down some 7 basis points, which is more than the average of 5 basis points on Jackson Hole Fed speech day. Coming up, we do have the hosts of Bloomberg's Odd Lots podcast. We have Tracy Alloway and Joe Weisenthal, plus Dana Peterson of the Conference Board. We're going to be dissecting the speech and what that means for the path ahead. This is Bloomberg Surveillance.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Creator. Our vision of the future is individual creators will look like Disney. They'll be able to go from an idea to a final story. They'll be able to publish that. They'll be able to merchandise it. They'll be able to do it across the franchises and stories they create.
Nobody covers technology like Bloomberg. Context changes everything.
The time has come to adjust policy. The clarion call from Jay Powell, the start of the rate-cutting cycle is to begin. The focus on the mandate has shifted. Tom Keene, Lisa Abramowitz here in Jackson Hole as we see markets surge higher on the heels of a speech quite a bit longer than the 8-minute pain speech that we heard 2 years ago, heralding the beginning of that rate-cutting exercise.
It's a substantial move here. What's important, I think of Ian Lingen at BMO Capital Markets saying that we've set a new regime of a lower set of higher yields, if that makes sense at this time of day. But the bottom line is, Lisa, is we come in with lower yields, bonds up, and equities lift up as well. Dollar weaker.
What we can see is the Russell 2000 leading the way up 2.5%. Yields lower across the curve, although backing away from some of the initial moves, down just about 5 basis points on that 2-year yield, 3.96%, confirming market expectations for a rate-cutting cycle.
You look at the 30-year mortgage, how it's coming in, Lisa. I know you want to continue the rate. You're looking at 3 bedrooms in Jackson. Think what the mortgage rate's going to be.
Why is it always about where people are going to buy property, Tom?
Because that's what's going to happen here, and this is when this is important. I asked this to Loretta Mester, and I said, is this just an economy policy for the haves? And that if you get a rate regime down, real estate explodes up once again.
And you also asked to buy some Portuguese real estate from the Portuguese head of the central bank.
We're trying to
move on a little bit. Joining us now to save us are the hosts of Bloomberg's On Laws podcast, Tracy Alloway, as well as Joe Weisenthal. Tracy, what was your takeaway from the speech?
I think it's clearly a shift from the emphasis on inflation to labor markets. I think what's a little bit interesting now is the Fed has emphasized so much that they are data dependent. I know they say they're not data point dependent, but data dependent overall. But with everyone now very focused on the labor market, I guess my question is, if we get an interesting jobs number, right? Like, what happens then? What if the jobs report comes in slightly better than expected? Does that put the entire path of the easing cycle in doubt?
Adam Posen alluded to this in his call, in his FT article 2 days ago. Dr. Posen made real clear everybody's setting up for complete disinflation, and he's saying, wait a minute, out in